I'm still optimistic, actually, that we are not talking about an overvaluation. I wouldn't say that the whole market is overvalued.
You've heard about all the AI infrastructure investment, and that's continuing to drive earnings.
You look at what's been happening in the AI stocks, we've got all the classic symptoms of a bubble. I do think it is a bubble.
Broadly speaking, the markets are holding up okay.
In situations like this, it's always okay till it isn't okay.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, coming off a week of gains, attempting to park the credit fears. Equity futures inching higher as President Trump lifts his top demands before meeting with China. Investors are looking ahead to this week's delayed inflation report. That number dropping on Friday.
So in this data desert that we've been experiencing, we're finally going to get CPI. In the meantime, the president really taking the knob down slightly. It's like a low simmer right now, Jonathan, when it comes to the rhetoric between China and Washington. And what the president is talking about is his top three demands: rare earths, fentanyl, and soybeans. All the policy issues that we've been discussing around this table for months.
So let's go to soybeans. That feels like the low-hanging fruit, if we can call it that. We're going to revisit purchase agreements, I imagine, between China and the United States. The question I have is, what does China want in return? Tariff relief or something bigger than that?
Well, I think twofold. On one point, it's that tariff relief to make sure that the president is not going to ratchet up that threat of 100% on tariffs. The others, of course, they probably want access to more advanced technology. The high-level NVIDIA chips that have been blocked, then put back on, that they were shrugging off. They want to make sure that they can have access to a lot of this, as well as there have been threats in the past. And Maria Bartiromo asked the president about this over the weekend. What about the Chinese companies that list on U.S. stock exchanges? That's been a rumor of a threat potentially that this administration can pull. Maybe they want that taken off the table.
So this week is the meeting before the meeting. It's the meeting between Treasury Secretary Scott Bessent, his counterpart in China, apparently over in Malaysia, before the big get-together a week away.
So I think this is really where we can finally establish and read the tea leaves on what was agreed upon before the two leaders sit down. And you make this point a lot. Usually it wouldn't be left to the last week before the premier leaders meet. But in this juncture, they are. So whatever comes out of Hali Fang and Scott Bessent's meeting is likely what's going to be agreed upon between President Trump and Xi Jinping.
The US and China, the relationship between the two were the epicenter of some of the price action over the last week. This morning, we're focused on one thing in the pre-market, Amazon. Not much movement, but AWS very much in focus this morning, identifying a problem causing widespread disruption affecting the likes of Perplexity, Coinbase, Robinhood, and potentially, snow day for adults. Disruptions reported across multiple platforms, corporate messaging service Slack, conference calling firm Zoom. I think this is the kind of thing that people might want to wake up to on Monday morning.
Absolutely, because potentially if you're trying to order an Uber or a Lyft, there's going to be challenges on getting to work, to your point of being maybe a snow day for adults. This is a problem in the U.S. East Coast. So anyone that's working on Wall Street, this is something that you need to take a look at. They are working on it, but they've had thousands and thousands of requests that there's a ton of shortages. It's degrading the services for several of these companies. So we're going to work with this disruption Monday morning.
And just for the record, if it wasn't for Annmarie, I wouldn't be sitting in this seat this morning because AMH called the car for me because the Lyft service wasn't working.
It was working for me. I had service.
So there you go. Equity futures on the S&P positive so far. We're higher by 0.3%. Coming up this hour, Russ Koesterich of BlackRock as stocks add to last week's gains. Terry Haines of Pangaea Policy as President Trump lists demands for China. And Ines McFee of Oxford Economics on whether AI is masking an investment recession. We begin this hour with stocks inching higher as investors await a week of earnings and a delayed CPI report. Russ Koesterich of BlackRock writing, we expect the economy to remain resilient. Fiscal tailwinds, monetary easing, AI momentum and favourable seasonals should support stocks into year-end. Russ joins us now for more. Russ, good morning, sir. Is there anything about the credit risk, the credit issues of the past few weeks that undermines that argument?
Good morning, Jonathan. I think you've got to be aware of the credit markets. But just to be clear, if you look at the broader aggregates, we really haven't seen anything that is that disruptive in credit markets. And we went through a similar incident back in March of 2023 with the regional banks, as you'll remember. So I do think you always want to be aware of the credit markets. But as you mentioned in the introduction, there are three factors right now that are a tailwind. The economy has been resilient. You've seen economic estimates come back, earnings estimates with that. The Fed is cutting into strength, and the AI momentum in the near term looks pretty solid. So as you think about the next, call it 3 to 6 months, in the absence of any new news, I do think that takes the market higher.
So, Russ, as you noted back in 23, there was a concern over regional banks, but largely, almost exclusively over interest rate risk. Here we are 2 years later, focused on credit risk and the risk that maybe the cycle is turning. Russ, is there something else that you would look for that suggests that maybe there's no evidence of that at all, that these are idiosyncratic issues, that if you look more broadly, things still look pretty good?
Yeah. Well, look, I think there are a couple of issues. The first is you have to acknowledge that some of the stress you've seen so far has happened with companies that are more geared to lower income consumers. And there is stress with lower income consumers. We've seen that for some time. That's been occurring since rates were going up over the last 1 to 2 years. So that is a pocket of stress. However, if I look at the broader economy, if I look at the wealth effect, if I look at where the labor market is, if I look at where disposable income is, do I see an economy that is evidencing the type of stress that would get you really worried about credit markets? Probably not. Again, pockets of concern, places you want to be aware of, but in aggregate, you still have a very resilient and robust economy, which should be supportive of not only the credit market, but also the stock market.
So, Russ, let's build on some of this. So you see reasons maybe to be comfortable with the idea that this does not migrate up income cohorts and ultimately topple the broader economy. With that in mind, Russ, what would you isolate? Parts of the equity market you would avoid for now, and what would you lean into?
Well, it's interesting. The parts of the equity market that you've done well to avoid have actually been the safest parts. This has been really going back to July of 2024, episodically a period of lower quality rally. In other words, high beta companies with less profitability have also been leading. What's been lagging? Companies that are stable but not evidencing much earnings growth. So areas like staples, for example, we've been underweight for some time. What do we like? We do like companies, one, that are geared to the AI theme. We've liked that for several years. We've kept that. We will trade around it, but it's still a theme in the portfolio. But the other is, again, looking for where do we going to see that cyclical impulse show up in earnings. And that is in select industrials. It is in select consumer names. And again, I think part of that is a play on an economy that's much stronger than people expected back in April and May.
When you think about consumer staples and also some of these companies that you say don't have a ton of earnings growth or you haven't seen it just yet, isn't the concern looking forward that they're going to challenge to generate revenue with the tariff impulse that everyone is saying we could expect at the end of the year in 2026?
Well, the tariff impulse, I think, hits the market in a lot of ways. And the truth is, look, there's still a lot of uncertainty. Clearly, there's a concern about how disruptive tariffs might be on inflation and also on company margins. So far, companies have done a remarkable job of navigating that by changing where they source, by being nimble in terms of how they price their products or services. So it's not as if it is not an issue, but you look at the earnings growth we saw in Q2, the early indications we're getting in Q3. So far, again, I think that narrative of companies being able to navigate the existing tariff environment regime, whatever you want to call it, I think that is still intact.
So, Russ, could we call time on the tariff uncertainty and struggles that this market has had?
No, I don't think you can call time on it. And again, I think it actually is indicative of a broader trend, which is that really since the pandemic and certainly since inflation kicked in 21 and 22, we've been in a market which in some ways is fundamentally different from the 10s and the aught years, and that macro volatility has been higher. And that's particularly been true in inflation. And that's meant that when you build a portfolio, you think about how you're allocating, you have to think about it differently. Bonds have been very effective in a portfolio, for example, as a source of income. On the other hand, they are less effective as a hedge than they were 10 years ago. So, I would put the tariff issue in the broader context of the macro environment's more volatile than it was 10 years ago. And that has to be part of how you build the portfolio. One example, to my mind, this is why gold is at $4,200 an ounce.
So, Russ, just to build on that gold position, are you saying that's a substitute for treasuries?
No, I don't think it's a substitute for treasuries, but I do think it is a more effective diversifier than it might have been 10 years ago in an environment where investors are more worried about store of value. They're worried about the long-term fiscal impulse, not just in the U.S., in Japan, in France, in the UK. They're worried about the dollar. So how do you think about positioning a portfolio for those types of risks? Gold is, to my mind, one of the parts of the portfolio. Now, the reason I say it's not a replacement for treasuries is, the old model of a 60-40 portfolio. Very few people are going to have 40% of their portfolio in gold. But I do think as part of that mix, it definitely diversifies some of these risks we're dealing with more today than we were 10 years ago.
So, Russ, let's just sit on that. 10s have come down to 4. We've seen a big rally at the long end of the curve develop coming out of the summer. 2s have come down to around 350. We saw that really start to accelerate after that weak July payrolls report back in early August. Russ, what's your advice to people now looking at the yield curve the way it is?
We continue to be mostly in the belly of the curve. We've gotten a little bit longer in our duration. Generally, we're pretty close to benchmark. So another way to put that, we're not taking a ton of duration or rate risk in the portfolio right now. We like the carry. As I said a few moments ago, part of what we've been doing in fixed income beyond the treasury market is thinking about what does that broader portfolio look like? Securitized, some EM, having a portfolio where you can clip that 6% coupon without taking a lot of rate risk. Again, something you could not have done 5 years ago.
Russ, appreciate your time. Thank you, sir. Russ Koesterich there of BlackRock, breaking things down. Still comfortable being long equities. Equity futures this morning just about positive by 2 or 0.3%. Let's get you an update on stories worldwide with your Bloomberg brief. Let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. Widespread internet issues are being reported after Amazon Web Services, the world's largest cloud provider, suffered a massive outage. Amazon is investigating the issue, which is impacting dozens of platforms, including Snapchat, Coinbase, Perplexity, Robinhood, and Verizon. Shares are lower on the news. Meanwhile, Israel says it has resumed a truce with Hamas in Gaza after fighting over the weekend. Each side accused the other of breaching a deal brokered by President Donald Trump. The IDF warned it would respond firmly to any violation after launching strikes against Hamas in Gaza and suspending aid shipments. Some aid supplies have now resumed, but the key border crossing of Rafah remains shut. And French bond yields are rising after S&P Global Ratings downgraded its sovereign credit score. It's an unscheduled move that highlights the nation's fiscal issues and places its debt at risk of forced selling by some funds. S&P Global downgraded the country from AA- to A+, saying the nation's budget uncertainty was elevated. That's your Bloomberg Brief. John?
Yahara, thank you. Not a good weekend for the French. French bonds, French banks, French museums.
French jewels. The French jewels literally being ripped from the Louvre, as well as in terms of the downgrade. Yeah, it's been a rough few weeks for Emmanuel Macron.
Yeah, brutal. We'll bring you an update on that jewelry theft a little bit later in the program. Up next on the program, President Trump's list of demands.
One of the things I want is China's going to buy soybeans. I want China to stop with the fentanyl. Very, normal things. I don't want them to play the rare earth game with us.
Up next, we'll catch up with Terry Haines of Pangaea Policy, live from New York City this morning. Good morning. Equity futures this morning positive by 0.26% as we head into a key week for inflation data. We're finally going to get our hands on this at the end of the week. CPI drops on Friday, and this sets us up for the following week. The following week, a Fed decision next Wednesday. Then after the close on the same day, we'll have numbers from Microsoft, Meta, and Alphabet. So really, earnings season begins. We get a flavour of things this week. Netflix, Tesla, but earnings season really begins next Wednesday.
And then, of course, we have to wait weeks for when earnings season really begins in terms of the equity market and where it's going in the direction of travel with NVIDIA. Obviously, we want to know how these big tech players are advancing and the fact that they're spending billions of dollars in this CapEx boom to build out AI. And what do they have to show for it?
Back end of October gets really interesting. Lots of tech earnings, a Fed decision, and a meeting between the President of the United States and a Chinese leader. Under surveillance this morning, President Trump's list of demands.
I have a very good relationship with President Xi of China. We're having disputes on things. They're paying us a lot of money, tremendous amount of money in tariffs, and they'd probably like to have it be less, and we'll work on that. But they have to give us some things too. One of the things I want is China's going to buy soybeans. I want China to stop with the fentanyl. Very, normal things. I don't want them to play the rare earth game with us.
So here's the latest this morning. President Donald Trump naming soybeans, rare earths and fentanyl as top priorities for the US ahead of fresh trade talks later this month. Bloomberg's Tyler Kendall joins us now from Washington with more. Good morning, Tyler.
Hey, John, good morning. So none of these topics are necessarily surprising, but they do give us an outline to look out for as both sides re-engage ahead of that November 10th broader deadline for the tariff truce. Now, the White House does maintain that threat of an additional 100% levy does remain on the table, but President Trump himself said in an interview over the weekend that rates that high are not sustainable. Now, interesting enough, we know that this all came about because of that new unveiling by Beijing when it came to new export controls on critical and rare earth minerals. But people familiar tell us that behind the scenes, Beijing has actually been working in recent days to tamp down on at least some of the concerns that included here in Washington on the sidelines of the IMF meeting, where Chinese delegates told their counterparts that this new tightening in export controls wasn't intended to disrupt any normal trade flows. Of course, though, this has been an issue at the center of the conversations, and there's still a lot of big divides, including the U.S.'s own actions when it comes to some of those semiconductor chips related to the supply chain here. And that's why our analysts at Bloomberg Economics have long pointed to fentanyl, that topic, as being the one where we might see the most immediate impact. Of course, 20% of the tariffs on China currently are linked to the issue. But, John, it really does seem like soybeans are becoming the most pressing issue as U.S. farmers across the country are sounding the alarm that they're running out of storage space for unsold soybeans. A senior administration official tells me that they are looking at other export markets. They are working overtime when it comes to talking to these countries in Southeast Asia or even Africa to take in U.S. soybeans if China doesn't come to the negotiating table on the issue, and fast.
Tyler Kendall. Tyler, thank you. Annmarie, these numbers. The U.S., almost a fifth of China's soybeans imports a year ago. And this export season, not bought a single crop.
Zero. And this is why there's been a little bit of tension as well. You could see from the Agricultural Secretary, Brooke Rollins, that text message that she sent Scott Bessent, the Treasury Secretary, when it came to Argentina. You're announcing this swap line, a financial helpline to Argentina. At the same time, they're sending soybeans to China, which maybe our own farmers could have been sending. There's a lot of questions on, is this really America first?
Argentina, Brazil, filling the gap down in South America. Terry Haines of Pangaea Policy writing this: China had best show movement on rare earths and other hot button issues, or the US is capable of broader direct movement against China's economic interests. Terry joins us now for more. Terry, welcome to the programme, sir. Now, my initial reaction to reading that quote is, what's left to tariff? So what's left to do here?
Well, good morning, all. I think what's left to do here, frankly, is to understand that the economic issues of the moment, soybeans and fentanyl and the rare earths, are part of a broader geopolitical struggle, and I think that's the reason why we're not going to see any serious movement on this anytime soon. We'll probably get some action on soybeans. We'll get another nod on fentanyl. They'll continue rope-a-doping on rare earths, and in return, what you get from Trump is not a calming effect by saying tariffs are unsustainable, because what Trump and Bessent have always meant by unsustainable is that they're unsustainable for China. So it's not an attempt to calm. It's an attempt to tell China, look, we're perfectly willing to keep ramping this up if you want to. But if you don't, then you need to back off now.
But, Terry, hasn't it shown that it is unsustainable, what we're dealing with right now, especially when it comes to farmers? It's unsustainable for the United States as well?
It's not a pretty picture by any means, and I don't mean to minimize the problems that American farmers have at all. But this takes place in the context of a much greater geopolitical chess game, and the export markets for soybeans are one small part of that.
So China is holding on to rare earths. They're not buying U.S. soybeans. What do they want out of the United States besides lowering the tariff threshold?
Well, they'd like to keep talking, and they'd like the United States to go away, akin to 2019, 2020. What the Chinese very likely hope for is that they get some sort of small deal with Trump that gets trumpeted as a big deal. And what ends up happening is that the United States then goes away on bigger issues. And I think this time out, Trump's not inclined to do that. The reason I think that is because that's very clearly what he's signaling. I mean, they see the rare earths issue as a threat to military plus Western economic power and influence and ability to continue, frankly, and they'll defend that, and so this thing isn't going away anytime soon.
It's not going away, but what you're describing is the contours of a maybe small deal on 3 specific issues that could be done between He Fang and Scott Bessent. Why do we need President Trump meeting with Xi Jinping?
We need that because both Trump and Xi Jinping want that meeting to be able to show that jaw is better than war, and they're continuing to talk. And in this case, any kind of seeming rapprochement between these two leaders, lifts all boats, whether it be in China, which wants respect and wants to be seen as an equal, or the United States, where Trump knows he's going to get a pretty large market bounce out of a continued rapprochement.
Terry, this bout of escalation really started with China a number of weeks ago. They flexed their superior rare earth refining capacity. That's a move that does not come without risks. And Terry, I just wonder from your standpoint whether you believe that was a strategic mistake on the Chinese half.
I think it was clumsily handled at the very least. So I think I'll mostly agree with you on that. But also I found the timing interesting because what you had in this situation is, in the broader geopolitical context, you've got a Gaza brokered peace, which right now, of course, is teetering a little bit. But you got that. You got the U.S.-Argentina bailout, which, from a geopolitical perspective, is a pushback against China in South America. And you've got Russia under a lot more pressure, not only because they're not winning in Ukraine, but because the price of oil and other things imperil their ability. That together describes a Chinese and client state proxy defeat. So China, among other things, is reminding everybody that they're still here.
Terry, before we let you go on China, today is day 20 of U.S. government shutdown. We're just mentioning it now, 23 minutes into the program. When do you think the government will actually open?
I got early November after the New York City elections. What I think about this is that this is now morphed into a struggle for the broad center of the American public. Who's more reasonable? There's a lot of evidence out there that Democrats aren't winning that battle right now. And what Republicans see an opportunity to do now is kind of use the kind of no kings amuse-bouche plus the Mamdani election in New York City to continue to paint Democrats as extremists. So I think this goes on for a while.
Terry, just quickly then, you don't see that as a coincidence of the calendar. You actually think that's a connected story, what's happening in New York City and what happens in Washington?
Oh, absolutely, because what they'll end up doing is, and this gets teased all over the place and has been for a while. Trump mentioned it over the weekend, I think, too, is that, this is the face of the Democratic Party. That's what these people are up to. And notice, by the way, and not incidentally, that, neither Schumer nor Jeffries nor anybody else in New York wants to stand up to them. This is your Democratic Party, folks, as compared to us, who are already leading with the public on economy and crime and a bunch of other major issues.
Terry, appreciate it. Thank you, sir. Terry Haines there of Pangaea Policy down in Washington, D.C. Please, you brought up the shutdown. Haven't talked about it. Completely off the radar of the market at the moment. 3 weeks and counting. And it looks like, according to Terry, it could be another 2.
Punchbowl this morning talks about the cash crunch. Federal employees are slated to miss their first full paycheck this week. They are scheduled to get paid October 24th. That covers October 4th, October 13th pay periods. Government was shut the entire time. So you need to watch the 4 Democratic senators in Virginia and Maryland. At some point, they're going to cave.
We're going to get some CPI data. It might be a while before we get some payroll reports. Coming up on the programme, Amy Gower of Morgan Stanley on what's next for gold's record run. Plus, Yahira has your morning movers with Boeing in focus. For all the drama of last week, the S&P 500 higher by 1.7%, the biggest weekly gain since early August, and the gains continue this morning, up by 0.25% on the S&P, on the Nasdaq up by 0.3%, on the Russell. Some outperformance for smalls this morning, up by 0.7%. Let's turn to the bond market. Switch up the board. 2s, 10s, 30s. Two-year bond yields down for a third week last week. Likewise on 10s. Yields down across the board. 2s this morning higher by just a single basis point, 3.4698. 10s just north of 4% after dropping south of 4% through last week. I want to turn to gold to bring you an update. Gold so far this morning, shaky on Friday, positive today, up 0.1%, closing out the week for a 9th consecutive weekly gain, the longest weekly run since 2020. If we make it week 10, it will be the longest weekly stretch of gains going back to 1980.
It's been absolutely unbelievable. And you see some profit taking happen over the weekend from Friday to this morning, but still gold is up, even though everyone's talking about, improved sentiment when it comes to credit quality in the United States, less concerns going into this big meeting between Beijing and Washington. And still, there is still that appetite to get your hands on gold.
42.56. We'll get Morgan Stanley's view in just a moment. 3 hours away from the opening bell. Let's get you some single names, some morning movers. Let's cross over to Yahara. Hey, Yahara.
Hi, John. President Trump's latest comments on U.S.-China trade are helping to lift rare earth stocks. We are seeing critical metals up nearly 10% in the pre-market, while U.S. rare earth, MP materials also higher after they all suffered some losses in Friday's session. But today's gains, of course, come after President Trump said he doesn't want Beijing playing the rare earths game with the U.S., listing the minerals among his top issues ahead of trade talks this week. And we have a potential deal incoming, and that is causing shares of Hologic to rise 2.8%. Honor reporting that Blackstone and TPG are in advanced talks to buy the medical device maker in a deal worth more than $17 billion, including debt. And this is significant because if it goes through, the deal would rank as one of the biggest private equity takeovers globally this year. And we are also seeing a lift in Boeing shares, up 1.6%. Honor reporting that the FAA has approved a boost in their 737 production to 42 jets a month. The increase could start as soon as November, with plans to eventually hit 47 jets a month, with investors seeing higher output as key for Boeing's comeback and in its rivalry, of course, against Airbus. John?
Yahara, thank you. Appreciate it. More from Yahara a little bit later this hour. On a radar this morning, President Donald Trump laying out his top demands for China ahead of trade talks later this month. The president insisting Beijing stop playing the rare earth game, curb fentanyl exports and resume purchases of American soybeans. Elsewhere, French bond yields rising after S&P downgraded the country to single A+, citing fiscal woes. The decision raising the risk of forced selling, France losing the country's AA credit rating at 2 of the 3 major credit firms in just over a month. And finally, Japanese stocks closing at fresh all-time highs as the LDP signs a new coalition deal with the Japan Innovation Party. The move putting LDP leader Sanae Takaichi to become Japan's next Prime Minister.
Really interesting story because she is conservative on social issues, but actually she wants to have more fiscal firepower when it comes to how she would like to govern as Prime Minister. Very similar to a platform she'd like to extend when it comes to Abenomics. This makes me think that this is going to set her up to have a very good relationship with the Trump administration, because Trump talks a lot about how it was during Abe's reign that he really had this close relationship with Japan. that's the politics. On a market perspective, I think we're trying to work out how close the relationship will be with the BOJ. Just a touch of yen weakness coming back through. Dollar yen this morning, 150.77, and positive on that currency pair by 0.1%. Let's turn back to metals. Gold trading in a narrow range after a sell-off in precious metals on Friday. It's coming off a 2-month surge that has brought prices up over 60% so far in 2025. To discuss, Amy Gower, lead metals and mining commodity strategist of Morgan Stanley, joins us now for more. Amy, welcome to the programme. What a year for you and the team to track this story. Gold to the year today is up by more than 60%. Can we just reflect on Friday's price action? A massive trading range. What was the explanation for you and the guys, you and the team, as to what was behind those big moves going into the weekend?
Yeah, look, I think it's been a very, very big move. As you say, it's been a couple of months really of gold moving up to about $1,000 in that period since we had that more dovish pivot from Fed Chair Powell at Jackson Hole. So I think it's not surprising that we have a bit of volatility, especially when we're seeing that across other asset classes as well. And what we often see is if we do see other assets pull back, gold is often swept up alongside that as well. just because it's often used as a source of liquidity. We saw silver, platinum, palladium as well, all down even more. And I think this precious metals trade has been kind of all driving itself. And so as those pulled back, we had a bit of weakness as well in gold.
Amy, can we reflect on the pillars of this trade and how it started, the more recent rally over the last few years? A lot of people have pointed to the so-called diversification trade sparked by the war in Ukraine and the prospect of Europe confiscating Russian assets, triggering this diversification of central bank holdings, of the dollar exposure, taking on more gold. Amy, do you think the recent price action is more indicative of reaching a more speculative phase of this story?
Yeah, no, I think it's a good way to think about it. So 2022, 23, even much of 2024 was driven by central banks really upping their purchases of gold. And we still see this, but I guess it's reached a more stable level now. And so the big shift this year has been the exchange traded funds. And what we do see is that they are much more linked to what the Fed is doing, what interest rates are doing. So actually exchange traded funds have been selling gold for the previous 4 years and really only turned to net buyers this year, and that has really accelerated since we had that pivot from Fed Chair Powell. And then, of course, as you say, that there is, as gold does better, investors start to look at it more, rethink, how much gold is in their portfolio as well. So I think a lot of those discussions are going on, and as the price continues to work, I think people continue to look at it and try and increase their exposure.
Amy, as a number of banks have 5K on gold next year, we're in an environment where risk on, risk off, everyone continues to get crowded into this trade. Give us some context. Where have we seen this before in the past?
So I think we saw, I guess, similar moves in gold in 2020, where we had a big run up in price, and then actually that was, I guess, eventually pulled back as other asset classes took over and carried on going. I think that the difference this time around is that gold is rallying alongside everything else. So it feels like everything is doing well all at once, and that makes it maybe slightly different to previous rallies. And I think at the moment, probably the most risk to gold is, if we did see other asset classes also starting to pull back, because everything seems to have become a bit more related. So, I would think if we did get a more meaningful pullback in equity markets, for example, gold would not be immune to that, particularly as it's often used as a source of liquidity.
Gold seems to be lifting all boats. Silver is also having an absolute moment as well, also up on the year, double digits. Do you see that being part of the momentum of the gold trade, or is that its own story?
Yes and no. So silver, I guess, sits somewhere between gold and copper. So it has an industrial demand base. Particularly it's used in solar panels, which has had huge growth over the last few years. We do care about mining production, I guess, in silver as well, and that is mainly as a byproduct. So you don't tend to get much reaction on the supply side to prices. So we've had this industrial deficit for silver, but then also it's benefiting from investors buying exchange traded funds in silver, which are backed by physical metal. So you've kind of had this perfect storm coming together. And then more recently, it sort of had its own physical shortages as well. So there is a lot of metal in London, there is a lot of silver in the vaults, but a lot of that is now already pledged for exchange traded funds. So the amount of sort of freely available metal has really shrunk, and that's come alongside good demand in India seasonally, demand a few months ago as we in New York, thinking about whether there might be potential US tariffs on silver. So there's been lots of pulls on that metal while the physical availability has been quite tight. So yes and no, it is linked to the gold story, but it has its own drivers as well.
Amy, we'd love to finish up by talking about more broadly, you mentioned the miners, more broadly about the commodity story and how the miners might respond to that. I believe you also tracked oil back in the day, and both oil and basic resources had a bit of a bust over the last decade or so that I think injected some real discipline into the operators, both in the oil patch and for the miners as well. Amy, particularly the mining companies, how disciplined are they this time around not to react to the big rally we've seen across the board?
Yeah, look, I think we aren't seeing huge pickups in capex. I think what we've seen is perhaps more a preference for buying supply growth versus building it yourself. And I think there's a couple of challenges there. One is, if you want to start a new mine today, the process to get those mines approved has become much, much longer. And so even if prices are good for now and maybe for a few more years. By the time that metal comes to market, we could be in a completely different market environment. So I think that's one challenge. And then, as you say, there's been challenges in the past with debt levels and spending at the wrong time, and then supply all coming on when we didn't need it. So I think we are generally seeing capex discipline and perhaps companies trying to grow their own growth by acquiring assets or other companies rather than developing internally, and that probably will stay. I would say in gold we are seeing more feasibility studies being refreshed and updated, so clearly people are taking a look, companies are taking a look, but I think it could be some time before we see the volumes in the market.
I mean, there's a massive push domestically here in the United States, as you're well aware of, to boost production of certain materials, particularly rare earths. There's also a massive copper deposit in the United States that Rio and BHP have wanted to explore for a long, long time. You mentioned things like regulation, permitting. Is enough being done to speed up the timeline for some of these issues?
Look, I think we're certainly moving in the right direction, and it's not just the US, other governments around the world are looking at which projects can they prioritise, can they make the path a bit smoother, and I think, look, there is always a process to develop a mining project. You need to think about land rights, water rights, how you're going to bring the material in, bring the material out. So I think, look, it should be a process that takes some time, but certainly to sort of try and compress some of those timelines gives companies a bit more certainty and allows them to deploy capex with confidence. I think that's the key. So I think, moving in the right direction, but probably permitting timeframes are still quite long.
Amy, thanks for making time for us. Appreciate getting some time to lean on your experience. Amy Gower there of Morgan Stanley, who leads some of the coverage of mining and metals.
And this is actually going to be a huge conversation today in Washington. The Prime Minister of Australia will be making his way to the Oval Office, and Kevin Rudd, the ambassador, was talking about the fact that Australia equals the periodic table. But having the rare earths and having metals, but knowing how to actually mine them is another thing, and they're trying to offer themselves this help to kind of bring these two countries closer together because of the fight the United States is having right now with China.
A huge focus for this White House, particularly, as you say, going into that meeting. Let's give you an update on stories worldwide. Let's head over to Yahira Anand to get your Bloomberg brief. Hey, Yahira.
Hi, John. Amazon Web Services says most of its operations are succeeding normally after a widespread outage. The disruption from the world's largest cloud provider impacted a range of services, including AI companies, government agencies, and financial platforms. AWS identified a problem with a regional gateway on the U.S. East Coast that caused the issue. Shares are higher 0.2%. Meanwhile, Apple's newest iPhone is off to a strong start. Counterpoint Research saying the 17 version is outselling the 16 by 14% over its first 10 days on the market in both the U.S. and China. Analysts attribute the boost to the phone's improved display, more storage, and the upgraded A19 chip, plus a well-timed upgrade cycle for users who got their last phones during the pandemic. And the Louvre will remain closed through Monday after thieves stole several pieces of jewelry in a daring daytime robbery. On Sunday, robbers broke into the museum's Apollo Gallery and used angle grinders to break into high-security cases containing French crown jewels from the Napoleonic era. 8 of the 9 items in the cases remain unaccounted for, and police are still searching for 4 perpetrators. That's your Bloomberg Brief. John?
Yahira, thank you. 9:30 in the morning. 4 minutes. In and out.
This is what I find so shocking. How is this possible? Especially, you have tourists there. The museum is open. How do you do this in just a few minutes and not get caught? I don't know. It's unbelievable.
Thomas Crown-esque. There's going to be a movie on this one.
It definitely
no doubt
will be a
about
movie.
it. Up next on the programme, AI driving growth.
Almost half the growth in the US economy so far this year has actually come from this AI-related capex. Recognise that it doesn't go on forever, and there are limits to how strong you can see this performance go on for.
In just a moment, we'll catch up with Innes McFee of Oxford Economics. Live from New York City, you're watching Bloomberg TV. Kicking things off this Monday morning, just about positive by 0.2% on the S&P 500. Your equity market picture looks like this. Positive on the Nasdaq too, up by 0.3. On the Russ sort of small caps, up by 0.6. Earnings through the week from Netflix and Tesla. Then on to the big ones next week. Microsoft, Meta, Alphabet, all reporting next Wednesday, the same day the Federal Reserve reports its latest interest rate decision. Under surveillance this morning, a focus on tech, AI, driving growth.
Almost half the growth in the US economy so far this year has actually come from this AI-related capex. So it's almost as large as total US consumption spending. So this is the first time we've really seen that scale of capex driving GDP growth like this. Recognize that it doesn't go on forever, and there are limits to how strong you can see this performance go on for and how long it can last as well.
So here's the latest this morning. Investors looking for signs of strength beyond AI with a busy week of earnings still ahead. Ines McFee of Oxford Economics saying outside of AI, the world and the US are in an investment recession, but it's unlikely to become a broader downturn. Ines joins us now for more. Ines, good morning and welcome back to New York.
Morning, John.
Can you break down the numbers for us? So what is AI and basically what does the rest of the world look like?
Yeah, so I think the first thing to mention really is that a lot of people are focusing a lot on the AI investment numbers, and they're not necessarily thinking about the imports associated with them. So the net impact on growth is actually quite small, just from the investment portion. Outside of AI, of course, investment's been contracting for a couple of quarters, but we don't need to get too worried about that. Investment recessions are relatively common. Go back through the G7, for example. They're about twice as common as normal recessions. So one doesn't necessarily lead to the other. I think the key point for growth really is how these tech stocks are doing, the wealth impact on the high-end consumer and how that's actually driving growth, not necessarily just the AI investment.
This goes to the bifurcation of the US economy right now. The low-income cohort is really, really struggling and has been for a while, a number of years. Is there any reason to believe that's going to migrate up to upper-income cohorts as well?
I think that's the real uncertainty. Remember that low-income households, the bottom 20% of the income distribution, are only about 9-10% of overall consumer spending. So it's manageable if it stays there. But they are driven by very different things than the top end. So there's not a direct move from one to the other. We are, of course, in a very regressive tax environment in terms of tariffs, but also in terms of the One Big Beautiful Bill. That will see low-income consumers have their income fall by 2-3 percentage points, whereas at the top end go up by 2 or 3 percentage points. So I'm not sure that there's a direct link between the two. I think we've got to watch the stock market really to worry about that contagion.
How far does the stock market go to explaining how we can have an economy where employment levels have dropped off to the extent they have and retail sales have remained right up there?
Well, I think that's a big part. But remember, with the labour market, we're seeing two shocks. And this is the thing we've got to get a bit used to in economics, actually, is we've had 20 years of demand-side shocks and supply-side been relatively benign. Nowadays, though, of course, we're seeing much more adverse supply shocks. And that's what's happening in the labour market. We've got negative supply-side shocks alongside a cooling in demand. And that's how you can have this no-fire, no-hire labour market.
When you talk about this investment recession and the fact that we're not going to have a real recession, can the U.S. remain exceptional even with this investment depression almost?
Yeah, I think it can, because ultimately, let's think about the three big shocks in the world at the moment. First, you've got deglobalization, the impact of tariffs. That clearly is going to impact the surplus countries, Germany, Europe, China, much more than it is Europe. There's a strong correlation in our forecast revisions over the last year, given trade balances. Secondly, on the AI side, clearly the US is not only benefiting much more at the moment in terms of the investment and consumption picture, but should also do so in long term in productivity. And then thirdly, on the sort of policy dynamics, the US is not constrained in its fiscal position, whereas you look around the world, there are a lot of economies who are at the moment. So if anything, there's more upside, I think, to the policy stimulus in 2026 for the US.
Given this backdrop and the investment we are seeing in AI, how important is it going to be these tech earnings that are upcoming?
I think it's really crucial, actually. It's a rally that, for some is built on these earnings. If there's any pullback in the market, really might well pull out the rug from underneath those high-end consumers. I don't see that happening at the moment, but that, I think, is the key risk.
Do you think it's become more important than the Fed decision? And by important, I mean more important for the economy. The earnings we get from the mega tech players next week versus what Chairman Powell's got to say.
Well, this is probably my unpopular opinion, but I have to say I'm not sure that Fed rate cuts really mean a huge amount for the economy, certainly not in the next 6 months. Well, if you look at the structure of debt in the economy, it's far longer now than it has been in the past. We've got a situation where, as in most rate cutting cycles, we're seeing rates come down, but the long end of the yield curve rise, so steepening happening. So financial conditions aren't pulling back or easing as much as many people might think just by looking at the Fed funds. Whereas obviously, equity stocks are having a much bigger impact on overall financial conditions in that first phase of pass-through.
Interest rates are going to come down again next week. Most people think they're going to continue to come down. Are you suggesting that's not going to alleviate some of the issues in the labour market?
Yeah, I think that, fundamentally, Fed rate cuts don't have a huge impact on employment, certainly not in the next 6 months. And remember that a big part of what's going on in the labour market is a supply shock, and central banks can't really touch that.
What kind of risks is the Federal Reserve embracing if they're going to be lulled into an easing cycle by misdiagnosing the labour market to the extent that, obviously, based on what you've said, you think they are?
I wouldn't say that they're going to make a huge policy mistake or anything like that. Ultimately, we're talking about moving at 25 basis points, and ultimately from a stance that's pretty restrictive by all measures to something that's a bit more of a grey area. Who knows where neutral is? So it's not like we're going to go, in most forecasts anyway, into a period where we'll have really, really loose policy. So I don't think it's going to be a big mistake, but clearly it's something they can correct pretty quickly on either side. At least
not this side of May. The other side of May, once we get new leadership of the Federal Reserve, who knows what the future holds? How's that debate playing out in Europe? What kind of conversations are you guys having looking across the pond to the US at the moment?
I think there's a lot being talked about institutional quality of the US and whether that plays some sort of role in the obvious decline in the dollar that we've seen so far this year. To be honest, I think that's a little bit overplayed. Who knows who we'll see as the next Fed chair. But if they move rates by, let's say, 50, 100 basis points relative to where the market has them priced now, I'm not sure that's actually a massive change, to be honest with you. And frankly, we've got a very data-dependent Fed at the moment. Maybe a Fed that looks a little bit more towards the forecast and thinks where policy should go and what impact it should have would be a good thing.
Especially given we don't have much data at the moment, and it's good to see you. Innes McFee there of Oxford Economics, breaking down the contribution coming from AI investment and what we could see from this Federal Reserve going into May when we get that change at the top of the institution.
And overall, what he's talking about is that AI investment. What does it mean for the top cohort spenders? Because right now they continue to spend and drive the growth in this economy, which is why I'm also interested in what firms like Procter & Gamble have to say this week. They were talking about $1 billion tariff hit last time they reported earnings. Where are they seeing consumer spend now? And are you seeing any of those high-end consumers potentially looking to maybe go out and buy deals at places like Walmart?
True. Just quickly, what's the latest on the leadership race at the Fed? I have to say, if you'd asked me a few months ago, I thought they were going to push this through pretty quickly, but it's taken a while.
So I think the reason why there's less urgency now than there was over the summer is because the Fed is already cutting interest rates. So it's giving the White House some breathing room to take their time and decide what exactly they want to do. Also, remember, Jay Powell has yet to make it clear publicly, and I don't think he's made it clear yet to the president or the Treasury Secretary, that he is going to step aside from the Fed. We know that he's leaving the chairmanship, but will he give up his governor seat?
He has cut once already this year. That was last month, and he's set to cut interest rates again this year. That's going to happen potentially next Wednesday. I think most people believe that's exactly what's going to happen next Wednesday. Coming up on the programme, we'll catch up with Sarah Hunt of Alpine Saxon Woods. We'll speak to Henrietta Treyz of Veda Partners, David George of Baird, Tom Tzitzouris of Strategas from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance up next.
There is more inflation risk in the system than markets are currently pricing in.
It's getting a little bit bubbly again in October.
I think the risks to inflation are not really skewed to the upside.
Inflation is going to start becoming a concern if financial conditions remain as easy as they are and the Fed continues to preemptively cut rates.
To me, the big risk is that the Fed does too much too quickly.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P added some weight to last week's rally. Yes, last week's rally, even with all the drama. A week of gains. Up another 1/10% this morning, up 2 on the Nasdaq. In the bond market, 2s, 10s and 30s. You will get some CPI data later this week. 2s at 3.46, 10s at 4%. That inflation data drops coming this Friday.
Finally, we have some data coming out of the U.S. government, given the fact that we are day 20 right now today in terms of a government shutdown. But that's all we're going to get. We actually don't know when we're going to get the labor market reports, because we don't know when the government's going to open. Even so, we have other data coming out in terms of earnings from the big tech players. We're going to get some of them this week, like Tesla, and Intel, and then we have others coming next week that are going to be really important. And then, of course, the trade story. It's starting to take a simmer now. The president has outlined his demands, and the Treasury Secretary is going to sit down with his counterpart ahead of this meeting. And it does seem like both sides are slowly backing away from the hot, heated rhetoric we saw over the past 2 weeks.
Let's just stand the earnings. GM, Netflix, Tesla. Typically, I'd ignore Intel. I'll be very honest about that. And now I'm very focused on it. Does someone from the White House join the call this week? I mean, I'm joking. But there's a massive focus now for the White House
joking,
and this
are you?
administration.
Well, I don't know. I'm not joking. Maybe someone from the White House does join the call, at least minimum. So there's going to be someone that's going to look at what Intel reports, right? Because the United States now has an equity stake. They have, their hands in the game, in the cookie jar of this company. They want to see what they report. I'm more going to be fascinated about how the CEO, the CFO, the C-suite talk about the U.S. government stake in the company. And also, since that U.S. government stake, are they starting to get more calls from potential customers? I'm sure they are.
I'm surprised by how quiet China has been about the administration's involvement in Intel. And I've been waiting for this moment for the Chinese authorities, because Intel gets a lot of revenue from that country. Been waiting to see what Chinese authorities have got to say about increased state involvement in some of these tech players and how much access they'll continue to get to the Chinese market.
I think, though, the problem Beijing would have is, you're just doing what we've been doing for years. So they can't really poke fingers at the United States, because they just, in some measure, took a page from their playbook. But it's going to come down when it comes to things like Intel. This meeting is going to come down. I know we're going to talk about soybeans and fentanyl, but really the most potent weapon China has in the United States is rare earths. And what the United States potentially could give to China is more access to advanced technology.
And the tension around that has really whipsawed this market over the past week or so. Equity futures on the S&P positive here by 0.2%. Coming up this hour, we'll catch up with Sarah Hunt of Alpine, Saxon, Words with Wall Street, looking to turn the page on credit risk. Henrietta Treyz of Veda Partners as US-China trade friction eases. And Tom Tzitzouris of Strategas as the flight to gold continues. We begin this hour with stocks inching higher as investors look past credit concerns. Sarah Hunt of Alpine, Saxon, Words seeing the wall of worry becoming somewhat steeper. She writes the following: credit is usually the culprit in stock market sell-offs. Add to that concerns about equity market valuations, and we go a pop higher in volatility and lower in yields and equities. Sarah joins us now for more. Sarah, good morning.
Good morning.
Have we got a credit problem or an isolated fraud issue?
That is the big question. And I think that is something that is going to come under increasing scrutiny. You saw what happened with the regional banks. You saw some of the business development companies have some issues with their stock prices because people start to worry about that whole private credit boom and what is underneath the surface where you can't see it and whether or not that's going to be a problem. Right now, it looks to be somewhat isolated. But every time there's another thing that comes out, it becomes a bigger problem. And that sort of goes to Jamie Dimon's comment, right? So I think that is going to be the issue, and how much that continues for the next couple of weeks, months, days. It really depends on whether or not something bigger happens.
Did you find it odd that the Diamond comment became the headline for last week? At the same time, earnings knocked it out of the park on Wall Street and stocks finished the week higher.
Not really, because it sort of goes to that list of things that people are concerned about. And I think that people have been talking about private credit and talking about some of those illiquid areas of the market and whether or not there are going to be issues in there and you can't see what the valuations are for a while. So it's more that once something comes out, then it becomes a bigger problem. So I think that part of that was just the fact that something did happen and everybody was a little bit worried about that happening. So it's not surprising that that got latched onto.
It's hard to make the argument right now, looking across the banks, that net charge-offs are spiraling out of control, non-performing loans are increasing. I don't see much of that at all. Now, it's not to say that it can't happen.
Right.
And I can see why people are worrying that we go from 0 to 60 pretty quickly. I understand all that. But is there anything else outside of the issues we've discussed that support the need to worry?
I think the issue in credit is not with the big money center banks, which reported first and reported really good numbers. I think it's more down in the regional banks and in some of those private credit areas. And I think that that's the concern. And to the extent that that's not the biggest spending cohort, to your point earlier, then it's not that it doesn't matter. It's more that who's caught up in it and how bad is it going to be. And if it's not that bad, it's not going to matter. If it's a few banks that have a problem here or there, it's not an issue. But this sort of reminds me of the issue with treasuries last year when it was like, oh my goodness, now all of a sudden these banks that you wouldn't have thought of have a gap because of the mark-to-market problem. So it really depends on where this goes. If it stays somewhat small and contained, I don't think it's a big issue. But it's definitely one of the things that people are concerned about.
It's staying small and contained, at least at the moment, is what it feels like. Do you think all this spend and focus on AI investment can kind of put pest infiltration to the side?
As long as that continues and it doesn't look like that's got a crack in it, right? Because every time you see a crack in the AI story, whether or not there was something that went around, I think last week about how many hits this happened and whether or not that was smaller than it was and what does that mean? And I think that anytime you get a question about that, people start to question the premise of why valuations are so high. On the other hand, we do have rates coming down, and that makes a difference as well. Whether or not it makes a difference to the economy as such, it definitely makes a difference to investors and to the stock market because lower rates do make room for those multiples.
Jonathan asked this question last hour. Is it more important to hear from the tech mega giants than it is from the Federal Reserve?
It's both, but right now, if there's any slippage in earnings from the tech guys, I think you're going to see a more wobbly, more volatile market because with the lack of data and with the assumption that the Fed's going to cut at the end of this month, I think that right now that is not as much of an open question. But if you see anything in the earnings or if you see any concern in the earnings on the tech side or a slowdown meaningfully somewhere that can't be explained by we don't have this capacity to give people something, then I think people really start to worry about what that looks like and that spend direction looks like.
Have you got a company you'd be more focused on than others? Next Wednesday, the same day the Fed meets, we'll have Microsoft, Meta, Alphabet, the rest will follow. Is there one that stands out more than others?
I think it's the compendia of those who are spending the most, right? So it's all of them. And if anybody says something odd and everybody else doesn't say it, then I think it's okay. If you get a bunch of different comments that are like, well, we're pulling back a little bit here, or the year-over-year spend is going to be X instead of X plus 10, I think it's really going to be a question of what they say collectively, because collectively that huge spend in the top of the, basically data center market is what's been driving a lot of this stuff. So everybody kind of has to be on the same page, I think.
There's two very different approaches between China and the US. Of course, those two countries will become the focus of attention over the next week when the two leaders get together at the end of this month. China's shooting for efficiency. We saw that with DeepSeek at the start of the year. America at the moment, based on what we're hearing from these companies, is just shooting for massive capacity, investing tons and tons of money. Is there an approach that, as an investor, you feel more comfortable with?
Well, I think that right now it's harder for the U.S. to jump in and do the efficiency thing. They're going to have to, because the reality on the ground is the power that's needed for currently what is extrapolating from the demand is way bigger than we have. So there has to be an efficiency argument ultimately. And I think that there will be. The question is going to be, who does that affect the most? And I think at the moment, right now, it's just a race to get all the chips on the board. It's sort of like the dark fiber in 2000. It's like, we just need to put fiber down. We just need to put fiber down. And at some point, that has to work together. And I think that there will be efficiency in the United States, because I think there has to be. And the innovation will get there because you just don't have, power prices are already higher. It's already an issue. It's only going to get worse. And I think that that's something that will end up being solved. How exactly and who benefits the most, I'm not sure yet.
Yeah, how exactly is it going to be solved? Because obviously, potentially government regulation would have to come into play. When you think about the trade talks, that's, I'm sure, part of your wall of worry. Were you given some comfort over the weekend by the president's comments?
I think it's really difficult. A comfort just in the de-escalation, right? The words themselves are not as important as the tone. And if the tone is de-escalation on both sides, that's probably better for markets. It was when the tone started to get very hot on both sides that markets got very wobbly. And I think that that's one of the things where we just can't know the outcome, and what they say and what actually happens on the ground are not necessarily going to be the same thing, because it almost never is when people are doing negotiations. So we won't know what the final terms are in any near term, but the idea of less fighting versus more fighting is better.
But when you look at a meeting like that, are you concerned that it just bleeds into 2026 if it doesn't go well, some of this hot rhetoric?
Well, all of the tariff stuff is bleeding into 2026, right? Like in April of this year, we were all convinced that something was going to happen and it was very short term. And now all of a sudden that has been pushed out throughout the entire year. So now, yes, it will bleed into 2026. And I don't think that's necessarily a concern as much as it's reality on the ground. That piece of the wall of worry is going to continue to have to be climbed. And not just with China, but in general, China is obviously one of the biggest issues.
Just quickly, what's your favorite sector right now and why?
Well, I think if you look at some of the places like defense, which has already run a lot, but you've got some big thematic stuff that's not just AI, right? So Golden Dome, so some of the spending that's going to come that you know is coming is very helpful. So there are areas in the industrials and defense that are going to play into that. And I think that this is a very good time to be looking at longer term thematic investing because you know that there are places where they're going to continue to spend.
Least favorite?
Least favorite is tough. Consumer is really hard right now because I think that a lot of the low-end consumer is having a hard time. So consumer is mixed, and even high-end consumer is not perfect. So I think that there's some issues there. But it's interesting that the iPhone is finally getting that upgrade cycle that Dan Ives has been looking for. So I think that there's some good news in that regard.
Dan Ives has been waiting for a while for that. Let's put it that way. Sarah, it's good to see you.
Good to see you,
Thank you. Sarah Hunt there of Alpine, Saxon Woods. We'll bring you more on that Apple data later this hour. Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahira. Hey, Yahira.
Hi, John. Amazon Web Services says most of its operations are succeeding normally after a widespread outage. The disruption from the world's largest cloud provider impacted a range of services, including AI companies, government agencies, and financial platforms. AWS identified a problem with a regional gateway on the U.S. East Coast that caused the issue. Meanwhile, a cargo aircraft skidded off the runway into the sea at Hong Kong Airport, killing 2 ground crew in a patrol car. The plane's 4 crew members were rescued and taken to the hospital. The airport authorities said weather and runway conditions were suitable for flight operations at the time of the accident. The cause of the crash is under investigation, and the plane's black boxes have not yet been recovered. And French luxury giant Kering has agreed to sell its beauty division to L'Oreal in a $4.7 billion deal. The two companies will also work together to create, develop, and distribute fragrance and beauty products for Kering's top-line luxury brands. L'Oreal is the world's biggest dedicated cosmetics and beauty group. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. More from Yahira in about 15 minutes' time. Up next on the programme, coming to the negotiating table.
One of the things I want is China's going to buy soybeans. I want China to stop with the fentanyl. Very, normal things. I don't want them to play the rare earth game with us.
Incredibly reasonable. Asked from the president, how achievable is it in a meeting he'll have with the Chinese leader later this month? Henrietta Treyz of Veda Partners joins us next. Live from New York City this morning. Good morning. Easing into a brand new trading week, equity futures just inching higher by 0.2% on the S&P 500, on the Nasdaq up by a third. Under surveillance this morning, coming to the negotiating table.
I have a very good relationship with President Xi of China. We're having disputes on things. They're paying us a lot of money, tremendous amount of money in tariffs, and they'd probably like to have it be less, and we'll work on that, but they have to give us some things too. One of the things I want is China's going to buy soybeans. I want China to stop with the fentanyl. Very, normal things. I don't want them to play the rare earth game with us.
So here's the latest this morning. The Treasury Secretary Scott Bessent confirming trade talks between the US and China will take place in Malaysia later this week. The move bringing both countries together ahead of the November 10th trade truce deadline. Bloomberg's Tyler Kendall has the latest. Good morning, Tyler.
Hey, John, good morning. So this is certainly giving us an outline on what to look out for ahead of those planned talks later this week in Malaysia. And then, of course, President Trump's expected face-to-face sit-down with Chinese President Xi Jinping on the sidelines of the APEC summit later this month. Now, the White House maintains that threat of a 100% additional levy remains on the table. But President Trump himself over the weekend had said that rates that high are not sustainable. It is considered to be a softening of tone as we actually got some indications that China is also working to tamp down some concerns. People familiar tell us that this past week on the sidelines of the IMF meeting here in Washington, the Chinese delegation told counterparts that its recently unveiled curbs on critical and rare earth minerals are not expected to disrupt normal trade flows. Now, critical and rare earths have really been at the center of the talks, and they will continue to be, but we're really starting to see the pressure ramp up around another area, and that is, of course, around soybeans, as U.S. farmers across the country are now sounding the alarm that they are running out of storage space to keep their unsold soybeans, as China has not made a single purchase when it comes to U.S. supplies. Just for some quick context, China accounted for more than $12.6 billion worth of U.S. soybean exports last year alone. Now, John, a senior administration official tells me that the Trump administration is working to find other export markets and also other uses for U.S. soybeans. But I'll also throw one more dynamic on your radar that we should keep in mind here, which is that this official confirms that an expected aid package, an economic assistance package for farmers in the wake of this trade war, is currently on hold because of the government shutdown that is only going to add fuel to this fire going forward.
Tyler Kendall with the latest down in Washington. Tyler, thank you. To build on that story, Henrietta Treyz of Veda Partners joins us now for more. Henrietta, welcome to the programme. Pretty reasonable, obvious, intuitive ask from the President of the United States: buy our soybeans, stamp out fentanyl production, ease the flow of rare earths to the world, not just the United States. Henrietta, what does China want in return?
Well, China's in a pretty strong position here because, as Tyler was just laying out, the president has two choices. He can either negotiate a way to bring tariffs down and give China what they want and get a deal for China to buy our soybeans, or he can negotiate with congressional Democrats. And he's choosing to go with President Xi here on this one. So the primary endeavor has to be to find a way to get soybean purchases made from China again. And then we'll see if they actually deliver. They famously did not deliver in the phase one deal reached in Trump's first term. But the choice here, I think, is really telling, that the president would rather engage with President Xi of China and try to get a purchase agreement sometime in the next couple of weeks, rather than negotiate with Democrats. So I think
that's not entirely fair, is it? We're waiting on this is a clean continuing resolution, which, you know, when I remember during the Biden days, they would come on television and say it's the Republicans that are holding the government hostage. It's a clean continuing resolution. We have a number of Democrats, 3 of them, that continue to vote for it. Isn't it also on the Democrats to, at some point, open up the U.S. government? We're going to have another week where federal workers don't get paid.
Sure. And so they've tried 11 times to vote for that very same bill, and nothing is moved. So the alternative is try to negotiate with President Xi. And so I think that's what the president of the United States is preferring to do instead of offering different terms to Democrats.
Isn't this also John Thune and Speaker Johnson? Isn't it their job to be negotiating with the Democrats, less so the executive branch?
Yeah, absolutely. Especially Senator Thune. He's the only one who actually needs to negotiate with the Democrats here and get some sort of additional vote to shake loose. My time on Capitol Hill throughout last week showed very clearly that the Republicans in Congress are taking their direction from President Trump, and they're awaiting any kind of indication from him that he wants to throw out new ideas. And that's obviously not coming. I don't expect it to come at all this week. They'll have a Republican gathering at the White House on Tuesday, and then he'll leave town for Asia. So the government's going to stay shut down. I'm not expecting any breakthrough here. And as I mentioned, I think he'd prefer to negotiate some sort of off-ramp for soybean farmers with President Xi than change the terms of the current deal in the U.S.
As I mentioned, federal employees are slated to miss their first full paycheck. There's a great outline on some of these pressure points this morning from Punchbowl News. Do you think with federal workers missing paychecks yet again that you can have maybe see the senators from Virginia and Maryland vote for the clean continuing resolution?
That's the Republicans' hope. Their thought is that you can maybe peel off 3, 4, 5, 6 more Democrats to get the final 60 that you need. The Democratic strategists that we speak with throughout the week, last week as well, are saying you're not going to get this bill passed with just 60 votes. You're not going to be able to just peel off Virginia and Maryland. You're going to need to get, 70, 75 members. And I think what's interesting here is that there are a number of Democratic farm state senators who could be compelled to vote for a farm aid package, such as New Jersey, which you don't often think of as a farming state, but it absolutely is. So there's a way out here that I think ties some sort of negotiation over ACA subsidies with the farmers' bailout package, because they need it, and they're obviously not getting it while the government's shut down. They've run out of ways to pay for a whole host of these things, including federal employees.
You're obviously tracking the polls as well. Who's winning in the court of public opinion?
Man, you know what's funny? I don't think that the public particularly cares about the shutdown. And that's why you're not seeing the president unduly focus on it. The Democrats think they're winning. Republicans think they're winning. And about 9 points of independents thinks that Democrats are winning. But in general, it's basically a third, as some Republican strategists told me last week as well. So as long as there's not a tremendous amount of pressure, the TSA is not, quitting en masse or just not coming up to work, that will eventually start to happen, presumably. But for now, it's not a priority.
That's one of the more traditional pressure points, Henrietta. Right now, I'm with you. Wall Street doesn't care either, by the way. A lot of guests come on the programme, we don't even talk about it. When do we get to that point? When do we reach the limit of this, and where do you see that on the calendar?
I think the calendar is the right way to focus on it. You got to get through this meeting with President Xi, see if Trump's able to shake out some sort of deal on soybeans. And if that fails, then you move to Congress again. And it's going to be around that first week of November. So I'm expecting us to be shut down through Halloween. Sometime between November 1st and November 7th is an ideal sticking point when things really starts to get painful for everybody involved.
Henry, we saw some funds being moved around the Pentagon to make sure active duty servicemen and women were able to get paid. Can that happen again on their next pay period?
We don't know how long it can last. There's about $8 billion in R&D funding that's already legally subject to oversight and law restrictions. I mean, we famously fought a war 250 years ago to prevent the power of the purse being anywhere other than with Congress. So there is a serious amount of concern, especially from the appropriators, on where this money is coming from. It's going to run out, I suspect, by the end of this month. They're getting very inventive. They are stretching the law to the extent that they're able. But there's a lot of things that we need money for. Federal troop pay, WIC, SNAP, and obviously farmers.
So it sounds like this is all going to come to the head at the end of the month, early in November. If it doesn't, and the government continues to chug along while being shut, what do you think the ultimate pressure point is? Is it 2019 and FAA saying that a number of planes are going to be delayed in some key airports around the United States?
Yeah, I think that's a perfect lever to be focused on. I think the military pay issue is going to start to become a problem. This is a comprehensive shutdown, so there's no agencies open right now. So the data that the street is waiting for will also stop coming. It all starts to build and pressure on itself. I don't think there's any one silver bullet here that's going to neatly resolve this. I think a combination of a farmer's bailout, funding for the troops, missing the November 1st date when everybody's, ACA subsidies get hiked when they go on the exchange. That combo is really what's going to start to pressure it. But there, as you pointed out earlier, the Republicans really need President Trump to engage in the fight. And right now he sees no reason to.
Another guest suggesting we've got to wait until November. Henrietta Treyz of Veda Partners. Henrietta, thank you. That was Henrietta Treyz calling for a shutdown that reopens in November. Terry Haines of Pangaea in the last hour saying exactly the same thing. So we've gone without the September payrolls report, and based on this, might have to wait for the October one as well.
Right. And you wonder if the data is going to be reliable, given the fact that it's going to take a long time to collect some of this data, because not everyone was deemed essential like we were, that they were able to come back for the CPI report. So at some point, when are we going to get a really clean read? I think that's going to be in a few months' time. It has to be, 30, 60 days after the government reopens, a really clean read on what's been going on in the labor market. At the same time, the Fed's still going to cut interest rates.
It's going to take a while. Terry's point was rather different, though. Terry thinks that the Republicans want to leave the spotlight on the Democrats for the New York City mayoral election. Just the idea that the beating heart of capitalism, American capitalism, could have a socialist mayor in New York. And that's going to be the reality, according to the polls that we've seen.
Absolutely. He is leading in the polls. I think the debate also showed that this is someone that is splitting the others are basically splitting the vote between Sliwa and Cuomo, and it's Mandami's to lose.
Up next on the programme, we'll catch up with David George of Baird with an upgrade for regional bank Zions. That conversation up next. Lots of negative headlines about credit. Never good. Cockroaches. Never good. Your equity market was higher by 1.7% on the S&P last week. Small caps are up by 2.4%. The equity rally continues. Again this morning, up 0.3%. On the Nasdaq 100, up by 0.4%. On the Russell, smalls up by 0.7% this morning. In the bond market, 2s, 10s, 30s, 2s. Around 350, kind of anchored around those levels at the moment. Let's call it 347. Up a single basis point of the session through last week, lower. Likewise on 10s. The data of the week, CPI. coming up on Friday, going into the Federal Reserve decision the following Wednesday. So next Wednesday. Let's finish on gold if we can. What a rally we've seen for gold over the last few weeks, the last 2 months. 9 consecutive weeks of gains for the precious metal. And if we make it week 10, we're looking at the longest weekly winning streak going back to 1980.
It's absolutely unbelievable what's going on with gold, especially since no one in the market is saying this is the top. They're saying actually it's going to be 5K next year. And what's so surprising about this trade is risk on, gold goes up. Risk off, gold goes up. It's become this store of value for a number of different issues happening around the world at the same time. Fed cutting interest rates, concerns about global fiscal issues in countries like Japan and in Europe, and then as well as this slow turn story we've seen since Russia's invasion of Ukraine of more central banks wanting to get their hands on the precious metal.
Certainly reached a more speculative phase, that's for sure. Gold this morning, 42.63, following a really volatile session on Friday into the weekend. Into the session this morning, 2 hours away on the equity side of things. Let's get you some morning movers with some single names. Here's Yahara. Hey, Yahara.
Hi, John. We start over in France with PNB Paribas shares plunging 8% to a 6-month low after losing a U.S. court case over allegations it helped finance the Sudan government amid a genocide. A jury awarded $20 million to 3 plaintiffs, but analysts are warning that it could face a much bigger settlement, potentially in the billions of dollars. BNP says it plans to appeal. Meanwhile, President Trump's latest comments on U.S.-China trade are helping lift the rare earth sector, with critical metals up 8%, while U.S. air rare earths and MP materials are also surging after they suffered some losses on Friday. But today's gains come, of course, after President Trump said he doesn't want Beijing playing the rare earth game with the U.S. and listing the minerals among his top issues ahead of trade talks this week. And we end on Weight Watchers. This is a company that has been making strides after emerging from bankruptcy back in July. Shares are up nearly 5% after it announced a partnership with Amazon Pharmacy to deliver weight loss medications, including injectable GLP-1 treatments, directly to its members as demand for those drugs continues to soar. John?
Yahara, thank you. That stock up by close to 5% in early trading. On a raise out this morning, President Trump listing rare earths, fentanyl, soybeans as his top issues with China. The US is set to hold talks with Beijing later this week in Malaysia as the trade truce nears its end on November 10th. Elsewhere, positive news for Apple's upgrade cycle. According to Counterpoint Research, the iPhone 17 is outselling the 16 by 14%. The firm comparing the two devices over their first 10 days on sale in both the US and China. And finally, an update for you. Amazon Web Services saying its cloud service is recovering after a major disruption overnight. The issue affecting a range of customers, including government agencies, AI companies, financial platforms, and other sites such as Coinbase and Robinhood.
So it sounds like things are proceeding as normal now this morning. It's not even 9 a.m. So I think a lot of people were excited. I was getting some viewer notes that you called it a snow day for adults. Well, get out of bed if you haven't gotten out of bed already. You can't just blame it on that now. It's 7:30 in the morning and basically Amazon is like, we figured this out.
I mean, this is what you'd want to shut down, right? Zoom, without a doubt. Slack, without a doubt. Cut it off, take the day off.
Or Zoom shut down, CEO calls, get to work. Get back to your desk.
In-person
physically.
meetings. Is that a conspiracy this morning?
Take an Uber, take a taxi,
You sound like
take
Jamie
a city
Dimon.
bike.
Let's turn back to Wall Street. And not Jamie Dimon, but his more recent comments. Credit fears easing after loan blow-ups for regional banks such as Zions and Western Alliance. David George of Baird upgrading Zions to outperform, calling the pullback, quote, excessive. David published that note going into Friday's session. He joins us now. David, welcome to the program, sir. It's good to see you. Let's just start with how disciplined this company has been, Zions exclusively, with loan growth over the last few years. Can you just frame things for us, David, before we get into it?
Sure, of course. Good morning, John. Good to see you. So Zions it has grown, and this is, I think, fairly indicative of the banking industry broadly. Loans since COVID have really only grown in the 2 to 3% area. And if you think about going into the GFC, as market participants are always kind of trying to fight the last war, a number of banks were growing construction loans in the 15% plus area. So as we think about credit broadly, John, there's just not any bubbles that we can really see on bank balance sheets. We're obviously vigilant and keeping an eye on things. But again, like we said in our Friday upgrade of Zions, for the bank to lose $1 billion in market cap over a $50 million fraud loss, we think was more than excessive and provides an opportunity to buy the name here.
Clearly, David, people are still jittery after the events of a few years ago. A few years ago, around the regional banks, it was about mismanaging interest rate risk. And I guess there's a fear in general that people have mismanaged credit risk somewhere. And David, I understand where that's coming from. We had a period of very easy monetary policy, very easy fiscal policy, and people are making the case, as they often do, that the worst of loans are made in the best of times. David, you're not ignorant of that fact. I know that. I've known you for a long, long time. If there are pockets of weakness somewhere, where would you be looking and what would you be avoiding?
Yeah, I think that really, to answer your question, John, I think it's going to be broad-based, your traditional consumer and corporate loans. So it's going to manifest itself the next downturn or the next normalization, I would call it, would be in credit cards and home equity and mortgage. And then on the commercial side, it would just be in your traditional C&I, commercial and industrial loans. And it's not going to be, I think, in CRE. I think those problems have been largely identified and reserved for, and we're kind of working through those problems now. So I think it's going to be just something that's broad-based. And we are of the view that credit cannot get any better and that it will normalize. But to suggest that we're on the precipice of a disaster on bank balance sheets, we just think that is misplaced.
Let's go with what we know so far. So Tricolor, First Brands, the exposure to fraud that we heard from Zions and Western Alliance. Is there a common thread there, David, already across those things? Or is that sample, that data pool, still too small?
I don't think we should minimize that, obviously, John. And fraud is something that, as you both know, it's the kind of thing that manifests itself when we get late into an economic cycle. And as you said earlier, we have had a lot of tightening of monetary policy, and that tends to operate with a lag. So it's very reasonable to think that we will see some credit issues, and these frauds certainly are not to be ignored. But again, I think it's important. Everything needs to be in context and contextual in nature, and it's all a function of what market cap has been taken out of these stocks relative to what the actual financial and ultimate loss exposure is going to be.
John mentioned Tricolor. The Treasury Department in 2019 and the Wall Street Journal did an opinion piece about this last week, identified it and designated this company as a community development financial institution. So it was eligible for special grants. Do you think there was an oversight issue with Tricolor, then potentially there's going to be oversight issues with other companies like that?
Yeah, I'm not sure, Annmarie. I don't think that's something that it would be something that would be that I would be particularly concerned about. I think in this case, this was a situation where it was just flat out fraud. I think collateral in this case was double pledged or triple pledged. And I think it was just a fraud situation more than anything, rather than anything deeper than that as it relates to CR loan mandates or anything like that.
What we saw last week with Zion, do you think all of that was exacerbated by Jamie Dimon's comments for everyone to be lurking and careful about pests potentially in the credit space?
It could be. Jamie certainly has a way of making headlines every time he speaks, and for good reason. Obviously, he's a great CEO, has done a phenomenal job over the course of his career. But it's important to note that there have been a lot of comments over the last 10, 15 years about 7% Treasury rates and hurricanes and so forth. So again, it's important to have everything in context and to just kind of calmly think about these numbers and then just kind of frame those from a risk reward standpoint as it relates to the stock. So we're trying to help our clients make money in stocks. And when there's an opportunity, either on the short side or the long side, we want to try and be in front of it. And that's what we're doing here.
Well, I give you credit for upgrading the stock going into Friday, David, when everyone else was freaking out. That stock rallied on Friday and it's up again this morning. David, Annmarie mentioned JP Morgan's Jamie Dimon. I'm going through your coverage list of the 20 companies on the Bloomberg you cover, 11 buys, 8 holds. You know where I'm going. 1 sell. Underperform, JP Morgan. David, talk to us about that. What's underpinning that call?
Yeah, it's really important, John, as we think about covering these stocks, and it is to differentiate between stocks and companies. And to be clear, JP Morgan is probably the best company we cover if you just think about its product breadth and consistent performance really throughout the last 25 years that we've covered the stock, and we've been constructive on it. most of our career. But from our perspective, when JP Morgan gets to 3 times tangible book, it's simply unattractive to us on a risk reward basis. We think that there's much more value in a stock like Zions or Fifth Third or First Horizon or Huntington or PNC, where you can buy those stocks at 8 times earnings rather than JP Morgan at 15 times earnings. So I think it's a question of whose earnings are worth more. And from our perspective, JP Morgan, and for good reasons, great company, but it's just too expensive and is relatively over-owned, in our opinion, John.
David, you mentioned Fifth Third, a call that you had months and months ago. Fifth Third and the prospect of them turning up, getting together with Comerica. For many in this space, and we've heard it for a long, long time, this is the start of more to come. Is that how you see it? And who do you think's next?
You know, we do. Clearly, I think we're at 4,500 banks. There's still too many banks. And I think the regulatory framework has gotten much more conducive for bank M&A. So in the case of Fifth Third Comerica, that's a 6-month close, which is really remarkable if you think about it. If this deal was announced during the prior administration, it would be at least a 12-month, if not longer, closing process. So we do think there's more deals to come. On our list, we think First Horizon is the most likely sale candidate. We think that there's a number of potential buyers that would be interested in First Horizon, and it's a $25 to $26 private market value from our perspective. And Comerica, as you mentioned, was one of our top takeout picks, and we're very constructive on that Fifth Third Comerica merger. That Fifth Third has got excellent retail banking acumen, and we think that's going to be very complementary to Comerica as those companies come together in the first quarter of 2026.
David, appreciate your time. As always, buddy, thoughtful note going into the weekend. Thanks for sharing it with us. David George there of Baird, and what's happening with the regionals and why so much more constructive on certain names like Zions after the sell-off. The difference between companies and stocks. Can have a good company doesn't mean you've got a good stock based on how it's priced, and that's how he thinks about JP Morgan at the moment.
Right. When JP Morgan, when he said the 7%, though, I had flashbacks when the Fed was hiking interest rates, how different we are in a place right now than 2023. And Jamie Dimon made those comments on Bloomberg TV, how to stomp out inflation, they're going to have to keep hiking. We never saw 7% interest rates.
He's a risk manager, and I think he likes to anchor people's minds to the extreme and then try and get everyone to manage people, thinking about the wide range of risks. And ultimately, that's why you get these flashy headlines. I find it very distracting sometimes, and certainly the 7% story was somewhat distracting.
Imagine how distracting it is for him to go to bed when he's concerned about all these things. Hurricanes, 7%, credit cockroaches in the market.
In markets, there is always something to worry about.
True.
Equity futures on the S&P 500 firmer by a few tenths of 1%, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. President Donald Trump says the U.S. could purchase Argentinian beef in an attempt to lower prices for American consumers. U.S. beef prices have been high because of drought and reduced imports from Mexico. Trump has been working to help Argentina bolster its currency with a $20 billion credit swap line and additional financing ahead of midterm elections for his ally, President Javier Milei. Meanwhile, President Trump says the U.S. will halt all aid to Colombia and impose fresh tariffs on the country. Trump accused Colombian President Gustavo Petro of being an illegal drug leader, claiming drug trafficking has become the country's biggest business, with leadership doing nothing to stop it. Petro responded by posting that Trump is being deceived by his advisors. And the federal government shutdown continues, nearing its 4th week. The Senate is set to reconvene and vote later today. Republicans are pushing a continuing resolution to reopen the government at current funding levels. Democrats want a deal to extend health care subsidies due to expire at the end of the year. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. Up next on the program, going for gold.
In a world of positive real yields, you're not supposed to love gold, so there's something else at play here. What I worry about is people speculating on it now that you've had a pretty big move.
Had a major move. Up next, Tom Tzitzouris of Strategas, live from New York City. You're watching Bloomberg TV. Take a sneak peek of this week, and this week is really about setting things up for next week. So this week we get talks between China and the US, but that's about setting things up going into the end of this month when we have talks between the US and Chinese leader. Take a look at the earnings from GM, Netflix and Tesla, Intel. That's an appetizer for next week when we get Microsoft, Meta and Alphabet, and CPI on Friday. That sets up an awkward Federal Reserve meeting the following Wednesday. Next week when the Fed gets together, we could have inflation with a 3 handle, no employment report, and they still reduce interest rates. And that's widely what's expected into next week. Into this week, here's the price action. Equity futures on the S&P 500 firmer by 0.25% after a really solid weekly gain. I've mentioned a few times the S&P 500 was higher by 1.7%. That weekly gain, the biggest since early August. Up again this morning. On the Nasdaq by 0.3%. On the small caps, the Russell up by 0.7%. Turn to the bond market. 2-year and 10-year bond yields down across the board through last week. This morning, just a little bit higher on 2s, 346.77 on 10s, around 4%. Some money starting to drift back into treasuries. Remember all the freak out that people had early August? The Fed would cut, maybe they'd go too early, the long end would sell off. That hasn't been how things have developed. Yields have rolled over again as we exited the summer through September and into October. 2-year yields at 346, very close to the lows for the year. That's the story in stocks and bonds. Let's talk about precious metals. Under surveillance this morning, going for gold.
In a world of positive real yields, you're not supposed to love gold, so there's something else at play here. Gold is central bank diversification. That's really been happening since 2022. There's a lot of geopolitical uncertainty. I think gold makes sense in a portfolio as a hedge against some of these risks. What I worry about is people speculating on it now that you've had a pretty big move.
We've had a major move. Here's the latest this morning. Gold bouncing off a sell-off in precious metals on Friday. Ongoing economic uncertainty keeping the commodity close to all-time highs. Tom Tzitzouris of Strategas writing, we suspect that gold is telling markets that the US yield curve needs to steepen in order for tens to maintain their status as the primary safe haven. Tom joins us now for more. Tom, welcome to the programme. Understand the theory, but based on the price action, does it back it up?
Yes, absolutely. I think the price action is telling us that there are overflows into safe havens, and those overflows are going into gold rather than treasuries. You know, we've gone through a period, we'll call it 15 years, where anytime there was a bump in the night anywhere around the globe, whether it started in the US or it started in France or anywhere else, the flows into 10-year treasuries were just astronomical. And that's just not happening this time. Yes, you're getting some safe haven flows as we're seeing stories about bad loans and worries about systemic credit risk. And so 10-year yields are rallying, but they're not rallying as much as you would see in previous cycles. And so gold is getting the overflow of that safe haven flow. And that's really the big reason why you've continued to see this momentum trade in gold, in my opinion. Obviously, there's folks following into that, but it's the overflows from lack of appeal from the traditional safe haven that I believe is really the big driver in gold right now.
Tom, if you think of how deep these pools are, the gold pool just isn't deep enough to be the alternative to treasuries. I've heard that directly from Goldman too when they've come on the programme, which is why you've seen this massive exponential move in gold. Can it really replace treasuries, Tom, given the depth of the pool and available liquidity in the treasury market compared to, say, gold?
Absolutely not. It can't. And so eventually, if these fears of credit contagion, if they really were to spread and we start to see more signs of pests in the attic and stuff like that, then you're going to see 10-year treasury yields not just dropping below 4%, but rallying down to close to where 2s are right now. And that's not happening yet, but there's just the gold market's not big enough. The precious metal market's not big enough. The entire sovereign G10 market's not big enough. Treasuries are going to have to be the final outlet if there is that type of risk.
Tom, you're looking a lot about what gold is doing in terms of the treasury market. Are you also concerned about de-dollarization and countries trying to get their hands on gold because they don't want to touch U.S. dollars?
Well, you know, there's two reasons why we said the U.S. curve has to steepen here in order for the flows into gold to stop. One is that if there's an economic contraction in the credit cycle, which everybody's focused on right now, the other scenario is that we have strong growth in the U.S., the Fed eases into that. We have loss of Fed central bank independence, and de-dollarization just amplifies this. And so the curve has to steepen just to accommodate that. So two scenarios, a weak economy and a strong economy, both would suggest that one, gold is going to continue to see flows, And two, the U.S. Treasury curve, in order to compete with that, needs to be steeper. We just don't know whether it's going to be a strong economy or a weak economy. But in both scenarios, yes, absolutely, you see the curve should steepen and gold should continue to see safe haven flows. But the de-dollarization story is another reason why gold is rallying or picking up those overflows into safe havens that would otherwise go into treasuries.
So you don't think we're seeing gold move into a speculative stage? You think there's going to be more flows? How much higher could we see gold go?
Well, I'm probably not an expert on the precious metals market, but I will say this, that near term we look overbought. But if you think about all the potential flows into gold over the next, let's say, year, a reasonable estimate of 5,000 per ounce, I mean, that's not unreasonable at this point in time, because you're going to continue to have central bank buying, because you're going to continue to see the global, we'll call it trade environment, deglobalize, and there's going to be less demand for dollars. That's absolutely true. You're very likely to see inflation reaccelerate next year, driven by service sector inflation, not tariffs and goods inflation, but service sector inflation, as the U.S. economy begins to stimulate and reaccelerate ahead of midterm elections. So all of those would suggest there's a fundamental driver for gold to push higher. But near term, I would argue that we're probably overbought here, because the flows definitely seem speculative very near term.
So, Tom, that's gold. This is where the bond market move gets interesting for me, at least. If you believe that's going to happen, we've got a bond market rallying into potentially hotter inflation prints, and a Federal Reserve that, given how it's communicated over the past month, is willing to ignore those hot inflation prints. Now, if the Fed's willing to ignore hot inflation, Tom, will the market, will investors?
No, I don't think so. So I think in that scenario, you're talking about, yes, there's credit concerns, but they're manageable. The real issue is that the U.S. economy begins to reaccelerate. And in that scenario, the curve bear steepens, with 10s pulling away from 2s, but eventually 2s pushing higher as well, as the market probably takes one of those rate cuts from 2026 and just takes it off the table. So you get a bear market steepener, everything's pushing higher, but 10s push higher at a slightly faster clip. That's our base case forecast for this year, with 10s forecast to end the year back around that 430 zone. And next year, 10s pushing back up close to 5%, as the market realizes that the fear is gone. There is an economy that is still reasonably healthy, and Treasury yields have to push higher to accommodate the slightly higher pace of inflation and still slightly higher pace of growth, too.
That's an understandable argument for higher bond yield to the long end. Tom Tzitzouris of Strategas. Tom, thank you, sir. Today, though, not seeing that steeper curve. We're seeing a flatter curve, led by a move at the front end. Yields up by just a basis point. 10's just about unchanged. 2s to 347. 10's to around 4% in the bond market so far this morning.
What's so interesting about the CPI report, looking at the surveys, CPI year over year, 3.1%. And yet, the following week, the Fed is likely going to be cutting interest rates without the labor data that we know that they have a bias towards right now, but with hotter CPI.
No jobs data for September. Based on what we've heard from the policy analysts this morning, no data for October either coming up. It's going to be a while. It's going to take a few months.
They're going to be flying blind. We will not get the jobs data, but we will get in the increase following months is potentially continuous CPI data. And that's going to continuously basically show potentially that it's a hotter print. The Fed's going to keep cutting into that.
Lots of earnings this week. Some data as well. CPI coming out on Friday, that delayed inflation report. Up next, we'll catch up with Victoria Fernandez of Crossmark, Dan Niles of Dan Niles Investment Management, David Seif of Nomura, George Bory of Allspring Global Investments.
I'm still optimistic, actually, that we are not talking about an overvaluation. I wouldn't say that the whole market is overvalued.
We've heard about all the AI infrastructure investment, and that's continuing to drive earnings.
If you look at what's been happening in the AI stocks, we've got all the classic symptoms of a bubble. I do think it is a bubble.
Broadly speaking, the markets are holding up okay.
In situations like this, it's always okay till it isn't okay.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The rally continues live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equities higher by a third of 1% on the S&P 500. On the Nasdaq 100, up by 0.4. Outperformance on smalls. The Russell up by 0.8. In the bond market, pretty snoozy so far this morning. Might not be at the back end of the week. 2s at 346, 10s at 4% at the back end of the week. CPI data finally released, delayed from the last few weeks. We'll get that this Friday, October 24th. And in the lead up to all of that, you'll get some earnings from GM, Netflix, Tesla, and Intel. And you'll get more of a conversation between the US and China.
Right, we're going to get more of that conversation because the Treasury Secretary is going to be sitting down with He Fang, his counterpart, the vice premier, before President Trump and Xi Jinping sit down. The contours of the deal or agreements, remember this truce ends November 10th, is going to be around what the president outlined last night on Air Force One. Rare earths, fentanyl, and soybeans. The issue is, Jonathan, is it going to be some grand bargain? Most people say that this story is going to continue until 2026.
Let's take rare earths. There is an argument that China made a bit of a strategic mistake by flexing its muscles around its superior refining capacity on that issue. Why? It's going to accelerate US production, one. You're going to see that anyway. And two, it may well push the Europeans closer to the Americans on this issue.
They almost already are. They are talking about the fact that they're having these discussions on the national level and the European Union level about what they need to do to combat what they're going to be calling China's weaponization of rare earths. We also got data over the weekend. China's shipments of these magnets down for a second month. So it's not just the rhetoric, it's actually happening in real time in terms of the exports.
Things might have calmed down just a bit compared to where we were, but things are still simmering going into those negotiations. Equity futures this morning firmer by 1/3%. Coming up, we'll catch up with Victoria Fernandez at Crossmark as stocks are rising to begin the new trading week. Dan Niles of Niles Investment Management with key tech earnings on deck. David Seif of Nomura as we're counting down to the CPI report on Friday. We begin this hour with stocks edging higher as investors look for more rate cuts. Victoria Fernandez at Crossmark seeing it playing out differently. She writes the following: I anticipate that fewer cuts are ahead of us than the market is expecting. Victoria joins us now for more. Victoria, welcome to the show. Let's put some numbers on that. What's the market looking for? What are you expecting?
Yeah, well, we see, Jonathan, the market's expecting 2 cuts to come in. I was actually thinking that we would only see 1 more additional cut this year, and then probably not the 2 early next year that the market is pricing in as well. A lot of that leading to the coming from the fact that I think you're going to see the balance of risk shift back a little bit towards the inflation. You and Annmarie were talking about the CPI number, about the 3.1%, and that the Fed trying to cut leading into higher inflation. I think when you have a lack of data, especially labor market data, which is where they were so focused, but yet you're getting inflation data saying that that's higher, perhaps that balance, that shift in the balance of risks leads them to the point where they can say, you know what, maybe we hold off here. Maybe we don't do anything because we don't know what we're doing. We are flying blind here at this point in time, and we get 1 less cut. That could be one of the reasons we might see a steeper curve and we see yields move a little bit higher, as Tom was referencing earlier.
So here's the problem, Victoria. Chairman Powell's expecting the same thing. Said in Jackson Hole, we could see higher inflation prints, essentially a one-off, but not all at once. And Victoria, the message I took away from that is get ready for hot inflation prints, maybe through the remainder of this year, but this is the Federal Reserve that's going to ignore it. Why do you see it somewhat differently?
Yeah, I just don't think you can completely ignore the fact that inflation is moving higher, because I don't think it's going to be just a one-time adjustment. I do know, obviously, oil prices are coming down. There's some concerns around extra supply there. That will have downward pressure on inflation. I see that. But when you look at some of the other areas, you have service inflation moving higher. It's not just goods inflation. That's not tariff related. So if we're having non-tariff related issues drive inflation higher, and we've actually seen rents go higher. Redfin was talking about rents actually moving higher when that's supposed to be a huge component of what brings CPI down. Then I think you're going to have more pressure on that side. And if it's not tariff related, then I think the Fed has to take a different approach to how they're looking at inflation, especially if they're not getting data on the labor front, or if the economy holds up. You're looking at Atlanta Fed GDP now, 3.8% on GDP. So if you're having that strong growth, if you're having earnings and margin growth where it's expected to be 13% margin growth, then the labor market should hold up pretty well. You're also seeing monthly job break even around 30,000, according to the New York Fed. Without unemployment moving higher, I think it's going to be harder for the Fed to make a sound argument for those cuts if inflation moves higher.
Victoria, though, when we look at tariffs, do you think it is more than just a one-time shock?
I do think it's more, Annmarie, and it's because of the fact that it's not just in the goods sector where we're seeing that. I totally understand if we're saying all inflation is coming from goods. It's from the issues where we're going to have tariffs. That's the issue. We can look through that. But it's just not. That's not what the data is showing us. I think it's really important on this CPI number we get on Friday to dig down into the weeds and see where things are really coming from. If it continues to be on the services side, then I think you have to take a little bit of a different approach, look at it through a different lens, and say this is something that's building. It's not just one time because of tariffs.
How uncomfortable is next year going to be, though, with your case of inflation basically remaining sticky and a new regime at the Federal Reserve?
Yeah, it's interesting because when I look at what you're calling the new regime at the Federal Reserve, I really feel like the heart of that is all around banking regulation. And with what happened last week, that is going to start to shift. I know everyone said, oh, the administration is trying to get new people on there to lower rates more, to bring mortgage rates down. We know there's not a direct correlation between short rates, Fed funds, and mortgages. We know it's the longer part of the curve. I think more of what the administration was trying to do was get to where we could get banking regulation. And that's going to be a harder hill to climb now because of some of the issues we're seeing with the regional banks, with private credit. So I do think there's going to be some shifting in how the Fed approaches things, but I'm not sure that it's going to make a huge difference in how they move with Fed funds.
You mentioned the banks. Let's stay on the banks. So we had a bounce back on Friday. And for those of you just joining us this morning, good morning to you. We've got a bounce back again this morning. Zion up by 1.8%, Western Alliance advancing as well. What we know so far, Victoria, some isolated issues, possibly. And I put the emphasis on possibly. Tricolour, First Brands, and some fraud-related issues revealed by the likes of Zion and Western Alliance in the last week or so. Victoria, is that building up to anything? What's the common thread between all of that, if there is one?
Yeah, we're not seeing, I don't think at this point in time, this huge thread that's tying that all together. It does seem, and I'm not going to use that other I word that I know you don't like, Jonathan, but it does seem like it's more kind of one-off for some of these companies. And they're smaller in the sense that, it was less than 1% of the assets for Zion. So it's not a huge credit issue that is going to build into a financial crisis that we see typically before a recession. We've liked big banks for a long time. And one of our reasons is because the strength of the balance sheets are stronger because a lot of the riskier debt was moving to private credit. So I think we have to watch private credit, see what's happening in that element, and if we see defaults go up. But expectations for defaults are not rising significantly right now. That's something we need to watch. And credit spreads, did they widen out a little bit last week? Yes. But guess what? At the end of last week, we were right back to where we were about a month ago on investment grade credit. So I don't think we're getting warning signals right now that it's a broader issue. Credit, I think, is where we have to really watch, look at those spreads and see what happens there.
Victoria, just from the outside looking in, if I was a layperson away from all of this and had no idea what anyone was talking about, and then I listened to this story and how it's played out in the last week, I get that people are saying it's in private credit and these are issues for other people, but I'm hearing this and seeing it in the banks. I'm seeing it from JP Morgan themselves. I know it's not a big issue in terms of how big their balance sheet is. It's nothing compared to what they were talking about just last week. But Victoria, are we overlooking the potential that if it's one place that we're all exposed to it?
Well, I do think we're overlooking some of the flags that have been waving, and we've been talking about that for months. We've had these conversations with you guys. We've had them with our clients. There are little elements that we have to watch. You can't just ignore them all and say, great, it's a risk on market. Everything's great. Earnings are great. Let's just move on. This is what we're calling a high risk bull market. And it's because of these elements you're talking about. You have to pay attention to these. They have to be something that you watch. Right now, it's not telling us we have to have huge concerns, that we need to do huge shifts in our portfolio, but it is definitely something you cannot ignore. You have to watch it and see if you start to see signs that tell you there are bigger things ahead.
Idiosyncratic. I said it for you, Victoria.
I wasn't going to use the word, Jonathan.
I said it for you. I've never liked that word.
I thought maybe you're thinking like institutional.
No, idiosyncratic. When enough people say the same word again and again and again, it kind of undermines the definition of the word, right? One-off. Right. How many times are people coming on the programme saying it's a one-off? One-off issues quickly pile up to become one big issue.
Right, and then it's multiple one-offs, and then it's actually one huge snowball. I hear you.
Victoria, thank you. It's good to see you. You didn't use it. Victoria Fernandez across Crossmark Global Investments. Thank you very much. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Let's cross over to Yahira Anand for more. Hey, Yahira.
Hi, John. Amazon Web Services says most of its operations are succeeding normally after a widespread outage. The disruption from the world's largest cloud provider impacted a range of services, including AI companies, government agencies, and financial platforms. AWS identified a problem with a regional gateway on the U.S. East Coast that caused the issue. Meanwhile, President Donald Trump has announced plans to meet with Russian President Putin in Budapest in the coming weeks to discuss an end to the war in Ukraine. Ukraine's President Zelensky is expressing caution, though, over the venue due to Hungarian Prime Minister Viktor Orban's Russia-friendly stance. Zelensky says he'd still consider an invitation to Budapest if it's in a formal setting where the three leaders can meet. And the Los Angeles Dodgers are heading back to the World Series after sweeping the Brewers thanks to Shohei Ohtani's historic Game 4 on Friday night. Meanwhile, the ALCS shifts to a winner-take-all Game 7 after the Blue Jays defeated the Mariners 6-2 on Sunday. That series will conclude tonight in Toronto to decide who faces the Dodgers in the World Series. That's your Bloomberg Brief. John?
Yeah, Harry, thank you. Thank you very much. What that guy is doing,
Ohtani.
It's insane.
He's unbelievable. He's unbelievable. I want the Yankees to bring him over.
I'm trying to communicate this to the Europeans, what it would be the equivalent of when it comes to, say, European football. It's like being both Gianluigi Buffon and Lionel Messi at the same time.
At the same time. It's unheard of. Honestly, it's unheard of.
Incredible. Up next on the programme, the Morning Calls plus Dan Niles of Niles Investment Management as we look ahead to key tech earnings. That conversation just around the corner from New York City this morning. Good morning.
Right now, if there's any slippage in earnings from the tech guys, I think you're going to see a more wobbly, more volatile market because with the lack of data and with the assumption that the Fed's going to cut at the end of this month, I think that right now that is not as much of an open question. But if you see anything in the earnings or if you see any concern in the earnings on the tech side or a slowdown meaningfully somewhere, then I think people really start to worry.
Typically, the big data point of any given month is the payrolls report, but you're not getting that. It's not CPI. Arguably, the biggest data point this month for the economy and for the stock market is the earnings from major tech players later on over the next few weeks.
And for whether or not the high-end consumers can continue spending. Let's see. Everyone keeps saying what the mega cap tech companies have to say when it comes to earnings. It feels like everything is hinging on these earnings reports, and especially now, given that we're in this data desert from the U.S. government.
Equity futures positive here by 0.3%. The Nasdaq up by 0.4%. Outperformance on small caps. The Russell up by 0.8%. That's the price action into the opening bell. 1 hour and about 14 minutes away. Let's get you some morning calls. First up, William Blair initiating coverage on USA Rare Earth with an outperform, believing the company may get a sizable investment from guess who? The US government. That stock is up by close to 9%. Your second call from TD Cowen upgrading Ally Financial to buy, highlighting its credit and margin strength. And finally, Loop Capital upgrading Apple to buy with the street height target of 315, seeing a material upside for iPhone estimates. Let's stick with Apple. The 17 appears to be reinvigorating its upgrade cycle. According to Counterpoint Research, the new model has outsold its predecessor by 14% in its first 10 days in the US and China. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, it looks like some better news for the iPhone and for Apple.
Yeah, look, I think China has always been a big market for Apple, and this refresh cycle probably is going to be no different. And the way to think about it is, like, for someone like NVIDIA, they have completely de-risked from China. It reflects in their guide. In the case of Apple, because they are so deeply integrated in terms of the supply chain, in terms of the jobs for the Chinese market, that it's very unlikely that, they will be completely banned or prevented from selling into the China market. So from that perspective, I think it makes sense that you are seeing a refresh cycle there.
And Mandeep, is it the start of the upgrade super cycle that Dan Ives of Wedbush has been waiting for so many years?
Not yet. We don't think so, simply because Apple doesn't have, a good large language model strategy. Neither do their chips can run these models on device. Until that happens, they are behind Android ecosystem. That's where, the Google Pixel devices, even though they don't have a lot of market share, they do very well in terms of the capabilities because at least you've got, a native LLM that's running some of the functionality. So Apple needs that.
Better news for that company. Mandeep, appreciate your time. Mandeep Singh there of Bloomberg Intelligence. Apple up by 1.4% in the pre-market. Let's stick with tech. Investors looking ahead to Mag 7 earnings with Tesla kicking things off on Wednesday. Dan Niles of Niles Investment Management writing, the higher the AI bubble takes stock valuations, the more painful the decline is going to be for investors on the other side. Dan joins us now for more. Dan, good morning, sir, and thanks for making time for us. We appreciate it. Let's just think about how you see valuations currently and whether we risk undermining those valuations with the earnings we'll receive in the next few weeks.
Valuations are high, no matter how you want to look at it. Price to sales on the S&P 500 is above the 2000 bubble peak. Market cap to GDP, which is Warren Buffett's favorites, is above the 2000 peak. I don't think it matters. I think you're going to see valuations extend further. I'm very bullish. I think the market goes to new highs before Thanksgiving. There's one simple reason for it. It's easy money. The Fed's going to cut. I think, Jonathan, you had it right in a prior segment where you said the Fed's going to look at any inflation data, say it's transitory. They've convinced themselves it's that way, just like they did in 2021. And they're going to cut at least twice this year, potentially another couple of times next year. And then don't forget, you're going to get a new Fed chairman in May. President Trump's going to appoint him, and that chairman's going to want rates even much lower than where the current trajectory is. So unfortunately, and I say unfortunately because I think this bubble could inflate a lot higher, the fall on the other side of that is going to be vicious, much like we saw in 2000. But right now, you got to be bullish and try to take advantage of this because you don't know how much higher than this can get. Much like Alan Greenspan famously said, irrational exuberance in 1996, the S&P then doubled over the next 4 years before it finally broke. I think you have to look at it the same way this time.
Dan, you touched on something important, and I do wonder to what extent it's still underappreciated, just how easy money could be next year. There's a massive focus on financial conditions now. I understand why. But do you think people are still struggling to appreciate just what 2026 is going to bring?
Absolutely. And this is the reason. Think about it this way. If I told you, hey, Jonathan, we're going to get a global pandemic, your first thought isn't to rush out and buy stocks. Well, that's exactly what you should have done because the S&P finished the year up 14%. But why? It's because you jammed up into the U.S. economy about half of GDP between what the Fed did and the U.S. government did in about 2 years. Money supply was up 25% year over year. And to put it into perspective, during the Richard Nixon era of high inflation in the 70s, money supply's fastest growth was up 12% year over year. So I think that's what's going to happen. And that's why I look at the valuations and I go, they're just going to keep extending because you can find some measures where the market doesn't look as expensive. You can look at PE measures or free cash flow. But, the top level things that I tend to look at and go, well, companies are over earning right now, probably. There's no way you can't come to the conclusion all metrics are extended. It's just some are more extended than others. But as we've seen in the past, it just doesn't matter when there's a ton of money coming into the markets. And don't forget, the Fed's probably going to quit quantitative tightening as well at the end of this month because of some of the credit issues you rightly brought up, such as First Brands and Tricolor, et cetera. They're going to quit the tightening. That's going to act like another rate cut in some ways on top of the 25 we all know we're going to get.
So, Dan, let's go with the credit issues as well. And let's pair that with the period coming out of the pandemic and through the pandemic too. This was something we were talking about. Lots of money flushed into the system. Fiscal policy was easy. Monetary policy was excessively easy. And confidence in markets was sky high. And as you often hear from credit investors, the worst of loans made in the best of times. Now they're starting to worry that maybe we're seeing the consequences of that period in Tricolor, in First Brands. And people get nervous. There's always something to worry about in markets. Dan, you know that. People get nervous. There's more to come. What would you say to them this morning?
Well, here's the thing. You look at how Jefferies has acted, which had exposure to it. It's obviously, stressful, but they have $69 billion in assets. You look at what Western Alliance or Zion said about fraud that they were involved with, obviously stressful, but that's $180 billion in assets. But look at the banks last week. The 4 biggest banks in the U.S. reported. You also have the 2 biggest investment banks report. Between them, there's 11 trillion in assets. They all talked about the fact that, you know what, things look pretty good to them. Yes, when there's one cockroach, there might be more, as CEO of JP Morgan said, but you're always going to have some defaults. That's what happens. But the question is, are you properly diversifying your portfolio so you're not getting impacted by them? And the 4 biggest investment banks and the two largest investment banks, 4 biggest banks in the U.S., you didn't see anything really out of the ordinary that you'd expect. So that's why I think you're going to look back and say there's more coming, but there's always some bad loans made during cycles.
Dan, if we go back to AI for a moment, when do you think it'll be the time when the revenues will not be enough and you can see potentially that hit to individuals that are bullish on these stocks, as potentially these companies do not have the revenue or the capex left to continue spending?
Well, it's not a question of when, it's when do investors care? Because you could argue we're there already, right? If you look at capex for the biggest hyperscalers, the 5 biggest out there, over the past 3 calendar years, including this one, they will have spent about $800 billion in capex. Just this year alone, it'll be a little bit over $400 billion, up 60% year over year. In terms of AI native revenues, so companies that don't have other businesses but just focus on AI, the cumulative revenues this year will be $20 billion. Now, if you look at OpenAI in particular, they're 13 out of that 20 billion. And they're expected to lose $8.5 billion in cash burn this year. So you're already at a point where you could consider it problematic, but much like in the late 1990s, people aren't going to care until there's an issue. And something like what we've seen with Tricolor or First Branch, you see that with some of these data centers that are highly leveraged. You haven't gotten there yet because the cash flow at these big hyperscalers is still very strong. And so they can still afford to invest, trying to get to this, artificial generalized intelligence, which is, kind of the holy grail, which everyone wants to get to. But until the stock market starts to punish you, you're not going to see it. And with the Fed doing what it's doing and us getting a hyper, dovish Fed chairman, it's probably not going to get there for a while. I think by the end of next year, that's when you're going to run into a problem because the rate cuts will all be done. You're going to then have to justify these massive cash burns. And I think that's when things are going to be interesting.
Dan, appreciate it. Dan Niles of Niles Management. At the opening bell this Monday morning, 60 minutes away. Equity futures on the S&P 500 firm up by 0.3%. On the Nasdaq up by 0.4%. Some big outperformance on the Russell. Small caps up by 0.9%. Going into the cash open. We're just an hour to go until your opening bell. Let's get you some morning movers with your single names. Here's Yahara with more. Hey, Yahara.
Hi, John. Cleveland-Cliffs posted a solid earnings beat this morning, but it was its comments on rare earth minerals that stole the spotlight and is sending shares up 10% in the pre-market. Cleveland-Cliffs says it's exploring mining rare earth minerals from its iron ore deposits. And with the Trump administration, of course, taking stakes in these rare earth companies and vowing to protect the sector, it is no surprise investors are pushing up the stock this morning. Meanwhile, moving on to Sable Offshore, also jumping 12% in the pre-market after U.S. Energy Secretary Chris Wright showed support on X for the company's California oil project. The company has been stuck in waiting mode on state approval to reopen pipelines off the Santa Barbara coast. Analysts say that the federal backing provides confidence that the project could start up in late 2026. And a check on Boeing shares, they are up 1.4% on a reporting that the FAA has approved a boost in their 737 production to 42 jets a month. The increase could start as soon as November and with plans to eventually hit 47. Of course, the production boost is key for Boeing's comeback and in its rivalry against Airbus, whose aircraft has been selling fast. John?
Yahara, thank you. Just to touch on that energy story. You know, energy and mining CEOs are the original corporate diplomats, not the tech players of the moment, which is why Rex Tillerson was such an inspired choice all those years ago to become the Secretary of State. But this has moved on to a different phase. The amount of integration we might see between the White House and that space in the years to come, wow, are we seeing results already?
Yeah, it's unbelievable. I've also spoken to sources in Washington that tell you, yes, expect more of these outright equity stakes because they feel like they are too far behind when it comes to China, and they think this is the best way to get a handle and a grip on the fact that the United States really doesn't have access to the rare earths. And as China's going to use them and control them and not allow the exports of these magnets, you have a huge problem. Forget your iPhone. You have a huge problem in the defense sector.
We've joked about this. It's like a list of names.
Yeah.
Everyone's got them, just waiting for that big move in one of them to get bought out or at least invested in by the US government.
I mean, look at William Blair today. They put one of them as a new buy rating in anticipation of this looks like a company the US president would like to take an equity stake in. It shot up to double digits pre-market.
Big moves in the pre-market on that name. Equity futures more broadly doing okay, up a third of 1% as we count you down to inflation data out later this week. Delayed CPI because of the government shutdown. Bloomberg's Ender Curran joins us now for more. And just briefly explain what's special about this. Why are we getting this and not payrolls?
It's due to the cost of living adjustment calculations that are made around this time of year, Jonathan. So the BLS staff have had to come back in and make sure the data is released. That's the practical, mechanical side of it. Of course, it's also a critical piece of the jigsaw for the Fed too.
And how difficult is it to collect this data when the government is shut down?
I think it's going to put a lot of scrutiny. It is difficult to collect it, number one, Jonathan. But number two, it kind of adds to the overall sense of scrutiny on the collection methodology behind some of the key data inputs at the moment. And not just for the period where the government is shut down, but also the catch-up period when the government comes back to work and how they meld all of this together. A lot of economists are worried that the data sets we get now, both say on the critical components of jobs and inflation, will kind of be out of whack for a little while. But nonetheless, all that said, when we get these numbers Friday, there will be a lot of focus both on services, what are the costs of shelter, how is that changing in either direction, what's going on with airline fares, and then, of course, what's happening on the good side, any hint of feed-through from tariffs. So there's going to be a lot to break down when these numbers come out on Friday.
And isn't it strange that this will be the one official data point the government does have, can provide us, and the Federal Reserve will sit around the table next Tuesday for 2 days, conclude the meeting on Wednesday, probably cut interest rates, and maybe with inflation with a 3 handle and no jobs report?
Look, it's very odd, John. There's no other way of saying it. To your point, the Fed have signalled very publicly what they're sort of on track to do, so the markets expect that rate cut next week regardless. But if these numbers on Friday come in, adding to the idea that, look, there's still persistent inflation out there, it's not all about, as we know, it's not all about the tariff story. Look what's happening in services. If core inflation still remains around with a 3 handle well above the Fed's target, then okay, the Fed cuts in October, but there are some economists asking what happens in December and then what happens in 2026. So if these numbers come in, on the high side, it will certainly complicate the Fed story going forward. If they come in on the low and the benign side, then you would have to say it probably gives a green light for the Fed to keep going the way they are.
And great work as always. We'll be following you this week. And Karen there of Bloomberg down in Washington, D.C. Let's stick with the data. David Seif of Nomura, looking ahead to Friday's print, he writes the following. We see an acceleration in the core goods inflation due to tariff-induced price pressures and a mild deceleration in core services. David joins us now for more. David, good morning.
Good morning.
Bit of give and take there.
Yes.
Yeah, let's start with the services prices inflation.
Yes.
Why are we going to see that roll over just a touch?
Yeah, so we should divide services into housing services and let's just say everything else. So housing services were a little bit unexpectedly hot last month. No reason to expect that to continue. So we see housing price inflation gradually getting better, and that should start this month or with this Friday's print. So no reason to think otherwise on that. Now, if you look at everything else that's in core services, that's what we would call super core. And that does seem to be ticking up a little bit. Number of things going into that, but it is really, I would say, overall a broad-based set of services inflation there outside of housing.
When it comes to the actual data collection, these individuals weren't deemed essential at the start of the government shutdown. They were brought back because of the issues Enda was talking about when it comes to cost of living. Are you worried that the data is going to be murky?
Certainly seems as though there's a risk of what the data quality will be. I think that this coming CPI report, this one on Friday, is likely to be one of the better ones. These individuals were not actually on furlough for all that long, so they're not that far behind schedule. I think what's going to be more worrisome is next month or whenever the shutdown ends, as people come back from to the BLS and start to do work, they're going to have to go and survey people about what their job status was at some point in the past. And people are not terribly great at giving answers about what's going on right now, and they're even worse about it when asking about things that happened in the past. So we're through the survey week for what should have been the early November jobs report. And so already, even if the shutdown were to end today and people were to come back tomorrow, they're already going to have to ask about stuff that happened retroactively. And given that it seems as though the shutdown could continue for a couple more weeks, it will be that much further in the past that people will be asked about.
So it almost feels like this decision for the Fed to cut interest rates is going to be easier, say, one at the end of the year.
Yeah, so this one, it's hard to see what justification they would have for deviating from the dot plot, barring a major surprise in this Friday's CPI report. But the big thing that drove them, we think, to this more dovish shift has been the deceleration of the loss of momentum in the jobs market. And of course, they won't have any real data on that going into this meeting. So we see that as something that's likely to happen. We expect there to be another cut in December as well, but I do think it's a little bit more of a question mark. And if you look at the, I would say, enormous variation within Fed speak that has occurred since the September meeting, you definitely see a lot of sort of the more hawkish members of the Fed starting to push back, starting to say, okay, fine, we concede the October cut, but we really think we should be much more careful about future cuts.
Why do they feel more emboldened?
Well, I'm not even sure that they feel more emboldened, perhaps. I think it's just that they sort of had the what was it, the tablecloth yanked from under them, so to speak, at the September meeting. It was a pretty unexpectedly dovish shift in the Fed. Not such a surprise that they cut rates at all, and not even such a surprise that they were signaling some additional rate cuts. But the big surprise was that they did all that while upgrading all of their economic forecasts and increasing their inflation expectations. So you had a shift in their data expectations that were entirely hawkish, and yet a shift in their rate expectations, which was entirely dovish. And I think that really is something that the hawks are fighting back against.
I sat in this seat as those numbers came out and thought exactly the same thing. It was strange. I also think it's strange the way Chairman Powell communicated at the end of August to essentially tell everyone they can ignore hot inflation prints, and potentially for a long period of time. The argument coming from the chairman at the moment is transitory just without the word. When he says we could see inflation pick up, but it'll be a one-off and not all at once, that's basically telling people that anything between now and maybe through year end, if you get higher inflation prints, you can ignore it. Do you think that's a mistake?
I think we should be very careful about cutting into higher inflation. I do think, though, that this is consistent with how Powell has been in his almost 8 years as Fed chair. I don't think this has much to do with political pressure or anything like that from the Trump administration. We have seen Powell tack dovishly repeatedly throughout his time as Fed chair when there are relatively small hiccups in the data. This time it's in the inflation data. And oftentimes he's been proven right. This time we think maybe some caution is warranted, I would say.
Why is this time different?
Well, this time we don't really see inflation momentum moving back down to 2% in a clear and compelling way. And that's actually a stark contrast from a year ago, and it's a contrast to, say, pre-COVID. Both of those times inflation was either at or near target, or at least appeared to be moving back towards target. Here, inflation still seems to be coming in with prints that are well above the 2% target.
Can you see the next regime post-Powell actually looking to target just a target 2 to 3% and not actually try to get inflation back down to 2%?
Oh, absolutely. I mean, we've seen some of the more dovish people on the Fed, Myron, Bowman, Waller, all talk about the idea that an explicit 2% inflation target may not be the way to go. And that actually isn't super crazy in terms of what the Fed has historically done. That's really what the Fed did until post-GFC, when under the Bernanke Fed, it was changed to an explicit 2% target. And the reason for that was to make it clear to people that the Fed was not going to be happy with inflation well below 2%. And so it was really to try to move inflation expectations up. The question is, has is it time to retire that mentality? We're certainly not in that world right now where we're flirting with deflation or anything like that.
Aren't they operating as if they don't have a 2% inflation target anyway?
It's certainly a thing one could say, given the September shift. Inflation is above target. It doesn't appear that it's going to get back there in 2026. Growth looks to be close to at trend and accelerating. And you put all that together, and when they come out with a dovish shift in the face of all that, it does make it seem as though they are more tolerant of above 2% inflation than before.
What is different? What's changed about this economy that makes it harder to get inflation back down to 2%? When we used to have the opposite problem?
Yeah, I don't think it's a long-term change. I think that we are still dealing with the maybe last bit of the hangover from the post-COVID period. I think we were well on track to get there in 2026. I think also that the tariffs are probably going to add a little bit to inflation, less perhaps than some of the big fears, and not in a way that would necessarily lead to anything like what we had post-COVID. But there's a difference between saying it won't be as bad as feared and saying it will be zero. We still think there's something there.
David, it's good to see you.
Always
Thanks
a pleasure.
For being here. We'll be looking for that something when the data comes out on Friday. David Seif there of Nomura. Equity futures on the S&P positive by 0.4% with an update on stories worldwide with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. President Donald Trump has shared some of his top demands from China ahead of further trade talks. Rare earths, fentanyl, and soybeans are all listed as top issues. The U.S. and China will hold talks later this week in Malaysia with the fragile trade truce between the two countries set to expire on November 10th. Meanwhile, EU energy ministers have agreed to a joint position to ban all gas supplies from Russia by the end of 2027. Hungary and Slovakia did not support the ban despite ongoing pressure from the U.S. The bloc aims to reach a final deal before the end of the year. And another NFL Sunday is in the books. The Denver Broncos pulled off a stunning win, erasing a 19-point fourth quarter deficit to defeat the Giants 33-32. Elsewhere, the Patriots won their fourth straight game, while the Eagles got their offense rolling in a win over the Vikings. And in prime time, the San Francisco 49ers grounded out a 20-10 victory over the Falcons. That's your Bloomberg brief. John?
The Jets are so bad they don't even exist in the news wrap anymore.
I know. The producers are like, it's not even worth putting them in. I'm so sorry, Mohamed El-Arian, because he was at the game, the poor guy.
If you're watching this morning, Mohamed, I don't feel your pain because I don't support the Jets, but it's unfortunate. Let's put it that way. Up next on the programme, setting you up for the day ahead, plus George Bory of Allspring Global Investments. That conversation up next.
This is probably my unpopular opinion, but I have to say I'm not sure that Fed rate cuts really mean a huge amount for the economy. Financial conditions aren't pulling back or easing as much as many people might think just by looking at the Fed funds, whereas obviously equity stocks are having a much bigger impact on overall financial conditions in that first phase of pass-through.
The wealth effect helping upper-income Americans keep spending. We've got this strange gap between employment, huge step down, and retail sales, which have been pretty punchy, still coming out of summer. Equity futures on the S&P going into the opening bow firmer by 0.4% on the S&P 500. On the Nasdaq, up by 0.5. On the Russell, small caps up by 1 full percentage point. That's the price action as we count you down to the opening bow. The rest of the trading week shaping up as follows. Later on today, the president meeting with the Australian Prime Minister at the White House. Look out for that. China very much in focus. On Tuesday, earnings from Netflix and GM. Wednesday, Tesla and IBM. On Thursday, more earnings from Intel and Ford. And then on Friday, the main data point of the week, CPI data just around the corner, and going into the weekend, you'll get UMich, consumer sentiment. Let's stick with the data. George Bory of Allspring Global Investments writing the following. We expect the Fed to cut rates further, but the pace may be slow and measured, reflecting ongoing inflationary pressures. George joins us now for more. George, good morning.
Good morning, John.
Building on the previous conversation, where are those ongoing inflationary pressures coming from? What's the source?
Yeah, I mean, the source, I think, is pretty clear. We're seeing sort of small movements of prices moving up kind of continuously. It's not one broad-based movement, but sort of little flares coming up. That companies are trying to push prices through where possible, where you have good demand. You mentioned, that's the K-shaped economy, if you will, allows pricing pressure in premium goods, in high demand products, in certain commodities. But at the lower end of the spectrum, you're not seeing any price pressure. And so on average, prices are moving up, but they're moving up mildly. I think that's what the bond market sees. That's what the bond market is kind of looking through. And the expectation is that pricing power is not going to persist, that you've got a couple more months for this to run. But perhaps we've already crested and you're likely to start seeing that come down once we get into the new year.
That's goods inflation. Is there a services offset playing out here?
Yeah, again, I think there's a two-tiered component on services as well. Where there's pricing power, demand at the upper end of the economy or the upper end of the income spectrum is very strong. Demand for, tech services, for AI equipment, for where follow the money. It's very simple. Like, where are people making money, and then where are people spending money? And there's good, strong pricing power there, but you move one shade away and the pricing power fades pretty quickly. So, there is this kind of upward drift on average, but we know that it's not consistent. It's not universally spread across the whole market. And you're seeing some of that bubble up. Some of the credit concerns that we're seeing in the bond market, are because certain parts, maybe you've lost some pricing power because your client your client base doesn't have the spending power that's necessary to keep pace with some of these broad-based inflation fears.
Will the Fed rate cuts help those individuals?
Yeah, that's a great question and a great point. Not necessarily, at least not yet. As we've seen, the long lead time, the variables are pretty long and drawn out at this point, and so. On the margin, does easier monetary policy help growth over time? Yes, it does. I think that's pretty well established. However, is it going to suddenly create sort of a spark in job creation? Probably not. That will take time, much more time than perhaps, monetary policy will actually kind of drive. We know there's limitations to monetary policy, and the connect between rate cuts and job creation, that part is a little loose, to say the least.
The Fed is also somewhat flying blind. They're going to have CPI, but they're not going to have the labor data.
Right.
How has that made your job difficult?
It does make our job difficult. The Fed, we follow the same data that's released that the Fed follows, but the Fed has tremendous resources to be able to kind of try to monitor the economy in real time. We don't have that advantage, and there's sort of private sector data that we can tap into. There's survey data that we can tap into. So we can have a pretty good feel for the general level, but the granularity is harder to come by, and the longer the government shutdown lasts, the harder it gets. So then you have to pull in the reins from a risk-taking perspective, because you have to build a wider margin of error. Directionally, the economy does seem to be slowing, decelerating, but not collapsing. So we feel good about that. John's question about inflation, very, very pertinent. And it's difficult to tell with precision exactly where inflation is. We think it's mildly moving up, but we want the data. We want the granularity to be able to say with a certain degree of confidence, how much is it going up? Maybe where is the cresting point? And then importantly, how does that distribute through the economy? It's challenging to do that with a lot of precision right now.
Let's tap into this bond market. So yields have dropped, fallen across the curve. 2s are down to 350, sub 350 now. 10s around 4%, 399 so far this morning. The extra reason to buy bonds in the last week, worries about a turn in the credit cycle.
Yeah.
Do you share the concerns?
So we share some concerns. Obviously there's been a lot of talk about some very, high-level defaults. When a $20 billion company defaults, that's concerning. And that does draw a lot of attention. It's scary, and it should be scary. However, when we sort of continue to dig into as much detail and data as is available, it does sort of look to be somewhat contained in the sense that it's idiosyncratic, it's company specific. There are certain elements of over-leveraging that's occurred. The credit cycle itself, it's a very straightforward kind of pattern. Kind of money rushes in, it gets lent, and then somebody along the way kind of stumbles. And then the question is it a whole group stumble, or is it just one individual? Or does one individual fall and then everyone falls over that person? Right now, it still looks like it's one person that's fallen, but we know that there's been explosive growth in private credit. There's been very robust issuance, even in the public market as well. And so borrowing, the wheels of credit are turning. They're turning pretty quickly and pretty smoothly. And that in and of itself has helped the economy. And so it doesn't look like that's slowing down. Maybe it's slowing down a bit, but it doesn't seem to be stopping at all.
Can I just ask you a question, how you draw a distinction between one and the other? Something that's idiosyncratic and something that's broadly more problematic?
Yeah, no, that's a very good question. And when you have a series of uncorrelated events happening at the same time, they in and of themselves can cause, sort of concern, because the collective view is that we need to then pull back kind of risk-taking, and then that starts a bit of a domino effect. There's maybe a mini element of that happening right now, but it does seem to be on the margin. And I think you have two very strong things going for you. They're macro. One is the Fed. We just talked about it. The Fed's cutting rates. That tends to help financial markets more broadly. And then really importantly is that profitability is still strong, up and down the corporate sector. And that in and of itself is a major driver for what kind of keeps cycles rolling. So you can absorb a fair number of stumbles along the way, even if they happen in close sequence. But when you have sort of this this tailwind behind you, it is a little bit more difficult to sort of broadly kind of spread and go from what's idiosyncratic to systemic. What I think's between those two is a correction. And I think that's where we are. It's like a credit cycle correction. These are big defaults. They're in very notable names that are like right at the precision middle of the credit cycle.
Yep.
But it's also, there's like a cascading effect where lenders are now scouring their portfolios. Like, how much factoring do we have in the portfolio? Who are we lending to?
Journalists trying to work out the same thing.
Yes, exactly. And
Scary headlines from Jamie Dimon. George, I'm up against the clock, but this was fantastic.
Thank you for having me on.
Thank you, sir.
Fantastic.
Appreciate it. George Bory of Allspring Global Investments from New York City this morning. Good morning. We'll see you tomorrow morning.